I think the market kind of expects, them to continue in the direction that they've been going. Lately, if they do issue at the long end, a lot, I think it could matter. But I actually think it's more second order. I mean, it matters, but it's not, and it's going to matter in terms of, do yields stay at where I just saw them, like 415, 417? Probably not, but it's not going to take them to 470. It's going, 10 basis points, 20 basis points maximum. Again, it matters, but it's a second order in terms of the economy.
Down to about 416 this morning. Steve, it's got to catch up, sir. Steve Englander there of Standard Chartered. Yields down across the curve. We're down 3 or 4 basis points on a 10-year this morning. On a 2-year, down a single basis point. Your yield at the front end of the curve, about 437. With an update on stories elsewhere this morning with your Bloomberg Brief, let's cross over to Danny Berger. Hey, Danny.
Hey, John. Heineken shares are lower this morning, 7.6% in the European trade. The brewing giant's first half profit growth came in weaker than analysts had expected. Beer sales were expected to grow 3.4%. Instead, they rose just 2.1%. Heineken also took a nearly $950 million charge for a decline in valuation of its stake in China's largest brewer. It also flagged that U.S. weakness is clouding its prospects. Meanwhile, Alibaba shares, the ADRs are rising by the most in 2 months, 1.5%. It announced plans to boost service fees for merchants. Alibaba will start charging a basic software service of 0.6% for the fees on confirmed transactions for vendors on the Tmall and Taobao platforms. Merchants learned of the policy change on Friday, according to a person familiar. But Alibaba may waive the new policy for small merchants, the person said. And the FT is reporting that Swiss drug maker Roche is fast-tracking its weight loss pill. The company's CEO told the FT its plans were motivated by encouraging data. It had a study that showed 6.1% reduction in weight only after 4 weeks of using the medication. Roche hopes it can get its pill to market by 2028 and compete with the lucrative drugs made by Eli Lilly and Novo Nordisk. And that's your Bloomberg Brief. John.
Danny, thank you. We'll see Danny again in about 30 minutes' time. Up next on the program, setting the stage for September.
I think rate cuts are definitely coming. I just think that at this point, there's not a really strong case for waiting. I think it's time to start to focus on the risks of the economy.
That conversation up next, live from New York City. You're watching Bloomberg Surveillance.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions, has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Just a sneak peek of the payrolls guesses for Friday. The median estimate in our survey is 178. Top of the pile, Mike Gape and Bank of America at 225. Perhaps no surprise, because Mike Gape and Bank of America is still sticking with December for that first interest rate cut.
And saying that the economy is fine. It's sort of this huge division that we see breaking out between those who think that the economy is on the precipice of really deteriorating, and others who say, did you see the GDP or did you not see the GDP that we just got?
Citi at the low end at about 150, and they're looking for a cut in September. The scores look like this in the equity market on the S&P 500, up by 0.4%. The bond market rally continues on a 10-year. Yields are lower by 3 or 4 basis points. The 10-year down to 415.89. Under surveillance this morning, setting the stage for September.
I think rate cuts are definitely coming. I just think that at this point, there's not a really strong case for waiting. I think it's time to start to focus on the risks of the economy, the risks of the labor market, to minimize the risk of recession, which always occurs when the unemployment rate goes up by more than 0.5% on a 3-month moving average basis.
So here's the latest going into this big decision later this week. Investors widely expecting the Fed to hold rates steady at a meeting on Wednesday and set the stage for a September rate cut. The decision coming just 2 days ahead of another key data point, the July payrolls report. Lindsay Piegza of Stifel writing this, coupled with the Fed's assessment of cooling labor market conditions, 2 back-to-back months of improving disinflation may prove to be sufficient justification for Powell to offer the reprieve investors have been desperately awaiting. Lindsay joins us now for more. Lindsay, let's get straight to it. Wednesday, everyone expecting this baby step towards a September rate cut. What do you think that baby step looks like in that news conference Wednesday?
Well, if the Fed wants to open the door to a September rate cut, they're going to have to adjust 2 main key points in the statement. Remember, in June, they said it's not appropriate to cut rates until they have needed confidence. And they also characterized the improvement in inflation as modest. So we're going to have to see the Fed back off from that need for further confidence, suggesting that they're at that point. And they're also going to have to increase their assessment of the level of improvement in terms of disinflation. Those are going to be the 2 key points to really suggest that the Fed is gearing up for a rate reduction in September, despite all of the relatively solid data as a backdrop.
The backdrop also including a lot of warnings, Lindsay, that the labour market's about to break and they need to get ahead of it and cut interest rates at this meeting, this week, this month, in July. Do you think they start to put even more weight on the other side of the dual mandate at this meeting?
Well, they have been pretty clear. We've heard from Powell that the dual mandate, stable prices, full employment, have come into better balance. And so they are going to be focusing on both of those mandates as opposed to just reinstating price stability. But that being said, the labor market is not necessarily on the precipice of breaking. We have seen a loss of momentum. We have seen less tight-ish conditions relative to the start of the year, but we're still talking about a circa 4% unemployment rate, near 4% wage growth. We've seen non-farm payrolls, yes, with increased volatility, but an average pace of over 200,000 thus far for 2024. That's still indicative of a relatively solid labor market. So you couple that with inflation that has been stubbornly elevated, showing now only 2 consecutive months of improvement, with the core PCE stuck at 2.6%, there's very little justification for the need for a rate cut at this point, despite the fact that the Fed may in fact move forward, as this is clearly a committee desperate to provide relief.
So that's where I wanted to go with you, Lindsay. Within some of your commentary, you said the Fed is offering up, perhaps, if the data cooperates, the reprieve that investors are desperately hoping for. Do you think that if the Fed ends up cutting rates sooner than later, not necessarily this month at this week's meeting, but maybe in September, that would be a mistake really aimed at placating markets?
I do think that this is a Fed that is desperate to try and achieve that utopic soft landing. And Powell has been very clear, the committee in general has been very clear, that they understand that the risks of cutting too late may create unnecessarily large burdens for the economy, potentially leading to a downturn or an outright recession. But the committee has also recognized the risk of cutting too soon or too much, because that could allow inflation to come back. That could allow inflationary pressures to become more embedded into the U.S. economy. So when we talk about the risks, absolutely, there are risks of the Fed waiting beyond September, even waiting beyond December into 2025. But if we're talking about the risks of a potential downturn versus reinstating price stability, Well, as we've heard time and time again from the Fed, without price stability, the economy doesn't work for anyone.
You know, Lindsay, we've been looking into the earnings and trying to listen to what companies are saying. We've heard from airlines that say that they can't charge consumers as much as they have in the past. We hear from auto manufacturers that the issue is just how much can they cut prices to compete, to move cars off the lots. Where are you seeing signs that there really is this sort of resurgent inflation waiting in the pipeline at a time where a lot of companies are talking about price cuts, not price hikes?
Well, I think when we're talking about price cuts, we're talking about less price acceleration. Remember, prices are still rising in most cases when we talk about broadly across sectors, but it's that lack of downward momentum that we're trying to get from a monetary policy or from a corporate standpoint, that lack of upward pressure that they have been able to instill and continue to pass on these rising prices to consumers. But again, when you're talking about the indications of resilience, let's look at the consumer. The consumer momentum actually picked up from Q1 to Q2, suggesting that there is still a good amount of borrowing power, investment power, spending power out there in the U.S. economy. And that suggests that without indications of the consumer significantly faltering, the Fed still may not have done enough to reinforce the notion of instilling price stability, not hoping for price stability with a slower pace of disinflation, but getting us back to that 2% target.
Lindsay, I'm perhaps more interested in the Fed speak after the rate decision and after the payrolls report on Friday. And I'd love your view on this. I'm not saying it's your base case. I know it's not. I just want to understand, if we triggered the SARM rule on Friday, are we going to see a bunch of Fed officials run around saying, don't worry about it, it's not about demand, it's about supply? How do you think this is going to work?
Well, I think we're going to see two different storylines from Fed officials, as we saw via the dot plot. There's this growing dichotomy between Fed officials, those that are increasingly concerned about weakness, emerging weakness in the labor market, and those that are more focused on reinstating price stability. So if, in fact, we do see a weaker than expected payrolls report on Friday and we do trigger the SARM rule, I think you're going to hear two storylines. Don't look over here, continue to focus on inflation, and those that are saying, I told you so, we need to move sooner rather than later.
Lindsay Piesa of Stifel. Lindsay, appreciate it. Appreciate the input.
Thank you.
A little bit of scenario analysis at the end there. I know one individual who will be saying, look at it and make a move, and that's Andrew Holdenhorst of Citi, because he's the one guy looking for 4.2% on Friday.
Yeah, and that triggers a SARM rule. We've talked about sort of the psychological impact of that. People have differing degrees of sort of predicting how the markets are going to respond to that. Nonetheless, he's been calling for a more rapid cooling. I think the JOLTS number might be as important in some ways. We get that tomorrow, the job openings and how much they're coming down is sort of a real-time look at how much companies are adjusting their labor market needs at a time where there definitely is cooling growth.
I think you nailed it by bringing up the companies we've heard from so far. Can we get a clean read on where the consumer is at in America based on what we've heard from the airlines, the automakers, and some of the consumer-facing companies?
Absolutely not. I mean, this is the issue, is that you've seen incredible price increases in a lot of these cars. You've seen incredible price increases in some of the routes that we've seen with airlines. You see on the margins that things are maybe getting less frothy. Can we make that extrapolation, though, from this commentary that things are falling off a cliff, that people aren't traveling, that they're not buying cars? Nah, not really.
Cooling, not cool. How many times have we heard that from the likes of Bank of America and others too? In the next hour on Bloomberg Surveillance, we'll catch up with Linda Dussel of Federated Hermes, Jeanette Lowe of Strategas, Ed Ludlow of Bloomberg, and Amanda Lynham of BlackRock. From New York City, your second hour of Bloomberg Surveillance. Up next.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
The inflationary dynamics as well as the labour market are also signalling that there is a need or a necessity for the Fed to start policy easing.
I think the Fed should have been cutting earlier this year. Reason being that they've achieved their objectives.
These inflation numbers seem to be weighing down on consumer confidence, and that's why you see some of the softening that we're seeing.
Once things start to unwind in a negative direction, it tends to keep going, and that's why the risk here is significant.
Things are going to slow down in the second half, and we need to be ready for that.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Your second hour of Bloomberg Surveillance starts right now. We'll talk about this repeatedly through the week. What a week we've got coming up for you. It starts with the economic data. It concludes on Friday with payrolls. That's the data. The week ahead for the central bank decisions, a triple header. You'll hear from the Bank of England, the Bank of Japan, the Federal Reserve, kicking things off on Wednesday. Look out for that. And then the earnings. Where'd you begin and where'd you end? The earnings for big tech. Microsoft tomorrow, Wednesday Meta, Thursday Apple, together with Amazon. Then you've got to wait a few weeks, wait a month. NVIDIA, the big players reporting this week.
Arguably, the earnings will be most important this week. Just the tech giants account for about 20% of the S&P market cap. If you take a look at all of the earnings that we get, in addition to the likes of McDonald's and others, AMD, you end up with more than 30% of the S&P 500 at a time where big tech has led the way down. Can you get a reprieve with some big beats from the four that we get this week?
Show me the money. I think that's what Manus Cranny was talking about in the last couple of days off the back of some of these tech earnings. You always get a feel a few weeks deep into earnings season what investors are willing to reward and what they're going to punish. And I think we got a flavour of that in the last week with the likes of Alphabet.
There has been this theory that you can't spend enough money on the infrastructure around artificial intelligence, and the people who spend the most on CapEx will be rewarded the most. And that died last week. We saw Alphabet actually spend more than people previously expected on CapEx, and they were punished for it, which is sort of this question of, is this something that needs to be monetized now and in excess of what investors are expecting in order to continue a rally that has been historic over the past few years, but that has absolutely hit a speed bump?
That's the earnings. For the Federal Reserve, I sense a little bit of calm. A lot more calm relative to where we were this time a week ago. Because going into last week, there was a sense of urgency from some people, including Bill Dudley, the former New York Fed president, who wrote that piece in Bloomberg Opinion let's go. Then the economic data came out and just settled things down again going into Wednesday. Do you think things are pretty settled down going into Wednesday?
There is a very small chance baked into the Fed funds futures market that the Fed does anything in terms of a rate move this week. Question's going to be whether they actually tee up a September rate cut, or do they just sort of give it the data dependence flavor that allows them to do it if the data cooperates? That, I guess, is sort of the big question. So that kind of took some of the steam out because you've got GDP, growing at 2.8% in the second quarter, and that really kind of threw some cold water on this idea that we were going into the tanker.
Jobless claims settled down a little bit as well. I think that was a key data point for us in the last week. We'll get another round of claims on Thursday, going into the big one on Friday. Payrolls Friday. Your economic data then, still ahead. The earnings, the central bank decisions, the scores into all of that look a little something like this. Equity futures on the S&P 500 firmer by 1/3%. In the bond market, yields are lower by 4 basis points now, 4.1550 on a 10-year. There's one thing we haven't talked about, but you'll hear a lot about it from a certain Lisa Abramowitz through the week. Quarterly refunding announcement from the Treasury.
Okay, I care about this because basically today they're going to give you an estimate of how much they're going to borrow, and then on Wednesday they'll give you a sense of what type of maturities they'll sell in at a time where you're talking about ETI, activist Treasury issuance. You're talking about the idea that this Treasury Department is trying to weight more heavily some of the issuance on the front end to avoid causing some sort of disruption in Treasury yields. For all those people who are falling asleep, this matters because the U.S. is selling record amounts of debt, and if they sell them in longer-term yields, you can imagine people will say, hey, can you pay us a little bit more to really buy all this stuff?
Just for the record, of course, I'm joking. I agree with you. A lot of people agree with you. It's an important story for later this week. We've talked a lot about a softer consumer. Certain companies just pushing back and saying, you know what, maybe we've reached a limit here. Here's another one potentially. McDonald's reporting just moments ago, Lisa, sales sliding for the first time since when?
2020.
Wow.
In the second quarter. And this comes at a time when you have same-store sales falling 1%. They talk about how diners are pulling back. They are being more discretionary. We talked about the $5 meal and how they are extending it to try to attract diners in. Just to give you the number, the second quarter adjusted earnings per share came in at $2.97 versus the estimate of $3.07. There is a question of how much this is political, international. We'll dig into some of the numbers. At the same time, this is something we have seen elsewhere also, that in order to bring in some of those diners, these companies are having to create value meals of sorts that really give a value proposition that we haven't seen in quite a while.
It's a pretty telling quote from the CEO in a statement. The chain will remain focused on, quote, reliable, everyday value as diners become more discriminating with their spending. Cost-conscious consumer. Saw it from Pepsi, didn't we? Heard it from Doubter and some of the airlines as well.
And you asked this question, at what point is this sort of a broader economic signal versus something that is specific to companies that have been raising their prices pretty dramatically over the past few years? How much is it a competitive edge of execution, and how much is it consumers falling off a cliff? We're walking that tightrope right now, where it seems to be on the edges. It's fine, but definitely showing that consumers are pushing back and rejecting high prices.
That wire's getting thinner and thinner. That stock is down by about 0.5% in early trading. Coming up this hour, we'll catch up with Linda Dussel of Federated Hermes as stocks gain ahead of a big week for tech earnings. Jeanette Lowe of Strategas with less than 100 days to go until the election. And Amanda Liner of BlackRock as the Fed prepares to meet. We begin with our top story. Stocks attempting to bounce back, going into a busy week of earnings, central bank decisions and economic data. We'll get results from Microsoft, Meta, Apple and Amazon, plus interest rate decisions from the BOJ, the Fed and BOE. And we round out the week with the US payrolls report. Joining us now to discuss is Linda Dussel of Federated. Linda, I want to get straight into these earnings. Thank you very much for joining us. We've seen it from consumer company after consumer company, pushing back, just warning about maybe a softer consumer here. Linda, how much weight do you put on some of these warnings over the last couple of weeks?
Well, good morning, Jonathan, and thank you so much for having me today. Of course, we're very, very interested in what the consumer does, but, you know, we've all been waiting to see them fall off a cliff, and retail sales do continue to surprise. Notwithstanding what McDonald's is saying today, it's the lower income cohort that we know ran out of the excess stimulus first, and it's really all about jobs. As long as we have jobs, job market is still tight. People, you know, unemployment is going up, but it's still historically low. As long as we have jobs, we're going to go shopping. And I think that the consumer remains underestimated.
So is this a loss of pricing power or just poor execution? I'm struggling here, Linda. How are you framing things?
Well, it's definitely a loss of pricing power for sure. And it's been an easy road for a lot of companies in these last number of years. Yes, we've had historically high inflation, but with historically high inflation, if you can push that through, your top line looks good. And to the extent that we have lots of stimulus money, which we have had, just running out of it this year, first time this year now, then we would spend up for it. So that's why we at Federated Hermes are watching in the earnings season for what the profit margins and the outlook will be. And it's still fairly early on in the earnings season to make a decision on how that's going.
Given that the consumer is still strong in your belief, but is definitely price sensitive, and you definitely have seen a lack of pricing power from particularly companies that cater to some of the lower end, do you think that the outperformance that has been historic in small caps, in some of the other non-tech names, makes sense?
Well, small cap, was historically oversold. It had never been this inexpensive versus the S&P 500 since before the tech bubble burst. So if you look at the S&P 600, the PE ratio on a forward earnings basis is just about 17. That's 21 times for the S&P 500. They remain historically inexpensive. And what's interesting also about the small caps and where they start their move up this year, yes, it's been hard and quick, but they have never been historically so exposed in their trading to what was going on in the 10-year Treasury bond. So very, very exposed to what's been going on in interest rates. And you've just mentioned that we're at the low 4 handle on the 10-year right now. We at Federated Hermes think we'll be in a range of 4 to 4.5% for the time being in that area. That is a nice spot to stop and for the small caps to get a breath, especially small cap growth stocks.
There probably are people watching this who are throwing things at the screen saying, really, you're going to talk about small caps before big tech when you've got the likes of Microsoft and Apple and Amazon and Meta all reporting this week. A lot of people saying it's so important, especially because of the significant reaction last week from Alphabet and Tesla. How high is the bar for some of these tech giants to really exceed and restart a rally that has really sputtered out with a true correction?
Well, I guess the bar is pretty high when you consider that the top 10 names in recent weeks represented 37% of the weight of the S&P 500 on market cap. They also represented 31% of the earnings. So if you've never been that high, that's way higher than what it was before the tech bubble burst in 2000, which means that if any one of them falls off, disappoints a bit, so many of us own every one of these names. We've booked a lot of profits and we'll sell right away, notwithstanding the fact that they're probably still very, very well-heeled, lots of cash flow and probably excellent prospects going forward. That's just part of the volatility that we've been thinking you would see this summer anyway in the market. So it's just it's just a trigger that you pull and then you step back and you say, but now wait a minute. They are not historically as expensive, again, as we were back in 2000. And I was there when that bubble burst. It's not nearly like that. These companies are still extremely profitable. I think we'll have to remember that.
A big week ahead for earnings in corporate America. Linda, we have to leave it there. It's good to catch up. Linda Dussel there at Federated Hermes. I've got Mohamed Al-Aaron on one shoulder, just sort of whispering and now shouting, listen to the companies. So let's listen to some of the companies. Nestle in the last week or so. There is value-seeking behavior among consumers. Pepsi, a few weeks back. In the US, there is clearly a consumer that is more challenged as Pepsi. This is McDonald's. The first slide in sales going back to 2020. They have this to say. They'll remain focused on reliable, everyday value as diners become more discriminating with their spending.
You asked the question, is this an execution question or is this a broad-based pullback by consumers? It's tricky to know the answer because on one hand, you have certain companies, Coca-Cola I can point to, that outperformed. You have certain airlines that have managed to do better than others, although albeit this is particularly difficult this time around. McDonald's in particular, there's also this issue of protests internationally, which they said is dragging on their earnings. So you start looking under the hood, and again, it's sort of, you hear that consumers are pushing back, but it's hard to extrapolate how far this will go.
That international story hit Starbucks as well, right?
Yeah.
It's in a similar story from those two over the last few quarters. McDonald's is up by about 0.7%, just bouncing back from early losses in the last couple of minutes or so. Equity futures positive still by 0.4%. Let's give an update on stories elsewhere this morning with your Bloomberg brief. brief. Here's Danny Berger. Hey, Danny.
Hey, John. Another attack has occurred on France's infrastructure during the Olympic Games. This time, a number of fiber optic cables were cut overnight. The cables carry broadband services across France's southern and eastern regions. Orange, the Olympic telecom partner, said the connections into Paris and thus the Olympics were not affected. Just on Friday, coordinated fires on French rail lines had disrupted trains ahead of the opening ceremony. And President Biden will call for term limits and ethic rules for Supreme Court justices later today. It's part of a sweeping new proposal. It also calls for a constitutional amendment to ensure that former presidents can be tried for crimes committed while in office. The plan, though, faces a difficult path in Congress. Democrats have increasingly called for reforms to the court amid recent controversies, but passing those changes would require support from the GOP-controlled House. And Prada is set to open a flagship 8,000-square-foot store in a Hong Kong luxury mall. That, according to people familiar. Construction will begin soon, and the store is expected to open early next year. It will become Prada's first major new location in Hong Kong in years. Global luxury brands have been increasingly returning to Hong Kong's business district, attracted by property prices that are trading at much lower levels than the pre-pandemic levels. And that's your brief, John.
That's certainly a demonstration of confidence there. Danny, thank you. More from Danny later on this hour in about 30 minutes' time. Up next on the program, less than 100 days to go.
That formula isn't filled out in the way that Trump needs in order to become president. He's still got splits in the party. The vice presidential pick makes it much more difficult for him to actually appeal to independents in the way that I think Harris and a centrist VP pick is likely to.
We'll continue that conversation next. That's just around the corner. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Wednesday, the Fed decides.
You said summers were quiet. I don't remember the last quiet summer.
We're talking about the data not being as accurate during this time of year, an election that's haywire.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Is the answer here, Jeff, that everything is just plain solid?
It's pretty solid, Tom.
At some point, we got to call it a soft landing.
Tune in to Bloomberg Surveillance, The Fed Decides, starting at 1:30 p.m. Eastern.
The focus has shifted to growth. The words of Mike Wilson of Morgan Stanley this morning, which is why for so many of you tuning in this morning, looking ahead to the week ahead, Lisa, there seems to be more interest in the earnings and the data than there is, say, the Federal Reserve on Wednesday?
It doesn't seem like the Fed's going to move. So other than that, how many times do you need to hear data dependence before you tune out? So this is the reason why people are looking at, hey, the data, which is going to be what will be the dependent upon notes for the Fed, as well as earnings, which are not only data points in their own right for the economics, but also dictating a massive part of the S&P based on earnings so far this week.
I think we're all excited and looking forward to just a week of conversations about a baby step towards a rate cut in September.
Right, that sounds fascinating.
Right, okay.
That's exactly how I wanted to really start my Monday.
Let's turn to the price action. We look like this. We're positive. The bounce back continues up by 0.4%. If you can call this a bounce, it's not much of one. Yield to lower by 3 or 4 basis points on a 10-year, 415.69. Under surveillance this morning, less than 100 days to go.
We've always talked about, double haters and how much people didn't want this race to happen, and all of a sudden there's a big alternative and a generational alternative. So far, that formula isn't filled out in the way that Trump needs in order to become president. He's still got splits in the party, I think, number one. Number two, the vice presidential pick makes it much more difficult for him to actually appeal to independents in the way that I think Harris and a centrist VP pick is likely to.
So here's the latest coming into this week. Donald Trump and Kamala Harris hitting the campaign trail. Harris heading to Georgia tomorrow and Trump returning to Butler, Pennsylvania on Wednesday. The latest Wall Street Journal poll showing Harris and Trump neck and neck. Jeanette Lowe, strategist, a Baird Company, joins us now for more. Jeanette, if the Democratic ticket was a stock, we'd call this a post-Biden relief rally. And we'd all be asking questions about the earnings releases in the quarters to come. And I'd be sitting here saying, what makes it durable? Tell me the fundamentals that supports this going forward from here. Can you point to what those fundamentals would be for Kamala Harris?
Well, I think the biggest thing that we've seen in this race is, that there was this absolutely lack of momentum or enthusiasm from most Americans about the two candidates they have. And so Biden getting out of the race, we were really starting to see his numbers go down since the debate. He was really starting to go impact down ballot races across the country. And that's really where we're starting to see the change with Kamala Harris at the top of the ticket. You're seeing the polling revert back to where it was pre-debate. So you have states like Pennsylvania, Wisconsin, and Michigan all within the margin of error. You have an enthusiasm gap closing, which you saw that in a poll over the weekend. And you're starting to really see people just engage. All of the calls that happened over the past few days of people really getting engaged back into the campaign on the Democratic side, that's what's really changed. Obviously, it's just been 1 week, so we still have a lot more to see what actually happens. How does this messaging start to play out? If we do have a new debate in September between Trump and Harris, does that change the dynamic? Just because then you'll now actually see the policy differences between the two candidates, and that'll be important to see. But the momentum factor has really what's kind of changed the race here.
Jeanette, with Biden at the top of the ticket, we were talking almost exclusively as one path towards victory potentially, and that path was narrowing. And it was a rust belt, and you just alluded to it. Politico reporting over the weekend that maybe, and I think you might agree with this, we've reopened the conversation about Sunbelt states. Would you agree with that?
I would. We did see there was an Emerson poll that came out last week that showed Harris really closing the gap, particularly in Georgia. So that's important. So I think that's one of the states that she's really going to be looking to. We haven't seen a lot of polling coming out of North Carolina yet, but I know that that's another state that she would like to target. The Democrats have been targeting that for quite some time, a couple cycles, trying to see if they could flip that state from red to blue. So that she does actually open up the map. She has more options. If she were to win, if she were to lose one of the blue wall states, she could potentially win one of the Sunbelt states, and that could actually still help her get over the finish line.
Jeanette, how important will be her running mate to determine how much she can really gain in the Sunbelt, especially given that we now have a short list of about 3: Arizona Senator Mark Kelly, Pennsylvania Governor Josh Shapiro, and Minnesota Governor Tim Walz?
Right. So, I think one of the things that's interesting is that, in general, a vice presidential candidate does not do a lot for the presidential ticket. They can only usually add, but they can also subtract, but they don't usually add very much. In the past, it's been easier for a vice presidential candidate to actually win their state. That's been less true in more recent cycles. But I think Harris has some options here. She has been looking at more of the moderate candidates along the lines of Mark Kelly or Josh Shapiro. Tim Walz would be a little bit more progressive than the other two. too. So that would be a potential change if she's going to now have more of a progressive ticket than a progressive moderate ticket. But Arizona is one of the states where she's not doing particularly well based on current polling. So Mark Kelly can certainly help her with that. He also provides this national security, this defense component that she may be lacking, which can be very helpful to her. Josh Shapiro, I think, can help her deliver Pennsylvania. So if she's worried at all about getting that, that is a key attribute of him. And he can also help her in the other blue wall states like Michigan and Wisconsin. But I think that they're also thinking that Tim Walz is going to be a really good bulldog on this stage. That is something that you generally do look for in a vice president. And also he is from a state that Trump is targeting in Minnesota. And so that can help make sure that that state is shorn up, but then also help in other Midwestern states.
Jeanette, Libby Cantrell of PIMCO came on here and said we should all just have cocktails, go away for August, and come back in September and take a look at the polls, and then we can actually discuss who is in the front seat to really be the front leader heading into the election. Michael Azizis of Morgan Stanley over the weekend, the business cycle is likely to matter more to markets than the election cycle in the next few months. Jeanette, from a policy perspective, why is it so important to really watch the policies at a time where you said this election is still a referendum on the speed of deglobalization?
Yeah, so I mean, I think this is really important that, for one thing, that this race, now that we have Harris at the top of the ticket, it's moved from less of a referendum on Biden and his acuity to a choice about policy. And so over the, we have less than 100 days to go, and Harris still kind of needs to figure out some of her policy positions. Is she going to continue the policies that she had as a 2019, 2020 candidate? Is she going to potentially moderate some of those positions? And this is going to be a race to the finish line. This is much less like what you would normally see in a U.S. election, where we have 9 months of campaigning. So I do think that the next couple of weeks will be quite important. What happens at the DNC? What happens at that convention? What kind of policy proposals are you seeing? Are you seeing momentum? That is going to be a key component of this. But there is still vast differences between the two candidates on trade, on taxes, on regulation policy, and that's going to be really important for this election. That's what investors are really focused on. What does Trump versus Harris mean for trade? What do they mean for tax policy? And what do they mean for regulation? And I think that's where we really have to be kind of focused over the next couple of months. And you do start to see the elections start to price in. We do have a metric that shows that the market can actually predict about 80% of the time whether or not the incumbent party is going to win or the party out of power is going to win. And that starts around August 5th.
We should do this every time, just 100 days, just a sprint to the finish. Jeanette Lowe, Strategas. Jeanette, thank you. The most revealing thing took place going into the weekend. I've got to bring you this quote. It was reporting from ABC, and they said this: J.D. Vance said Americans without kids should be taxed at a higher rate in a 2021 interview. It just revealed how polarized this country is. We saw so many people react to this, reflexively exposing their own political bias. The people in news who thought it was news, and the political commentators who tailored their response to that quote based on the author and not on the content of it, blinded by their bias, so they weren't able to see that that actual policy already exists in this country. How ridiculous was that going into the weekend?
You do get tax credits if you have kids up to a certain income. There is this issue of how polarized people have become and whether people can actually look at policy or whether it ends up being this sort of social issues that are hot button. J.D. Vance has said a lot of things that are getting a lot of attention. I think that there's a certain Tom Keene who would agree with you that it should always be a 100-day sprint. I'm just saying that's something that a lot of people are saying.
Very much a TKS thing. But how can we have a conversation about policy when that's where things go in this country every single time?
That's exactly the reason why we're not talking about policy. And that's the reason why a lot of people who come on here who are market participants, their eyes just kind of roll back in their heads.
Let's sort of ignore this and keep ignoring it. From a beautiful New York, good morning.
heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The latest from Evercore this morning. Good morning. You'll hear a lot of this. We think the July FOMC meeting that concludes Wednesday will signal that the Fed is on track to cut soon and open the door to a cut in September, but will stop short of explicitly pre-signaling that rate decision at that following meeting, because we have Jackson Hole in between. So there's another step there if they wanted to take it.
And people are expecting that to be really the time where they give a sense of what the policy shift is going to be and why they think it's so important to cut rates. Just to put this in perspective as to why we're not talking about the Fed meeting more, there is a 4% chance of a rate cut this Wednesday. There is more than a 100% chance of a rate cut in September. This is the de facto accepted position currently in markets.
And it's not about the first move. It's about the one after that, the one after that. What's the destination here? Where are we going? Do we have a decent understanding of what kind of economic regime that we're in right now?
And what's the backdrop in terms of, is it to fight off a slowdown, or is it just sort of proactively to prolong this recovery, this expansionary cycle, which is the good cut or the bad cut? And the reason why the jobs data, as well as JOLTS and as well as a whole, and the ISM manufacturing will be really important.
Couldn't agree more, just to echo that. The difference between the wrong kind of rate cuts and the right kind of rate cuts. Payrolls Friday. Look for payrolls this Friday. The scores going into all of that look a little something like this. Equity futures on the S&P 500 up by 0.4%. On the Nasdaq 100 up by 0.7%. The outperformance on a Russell over the last few weeks continues, up by 0.75% on a Russell 2000 this morning. Lots of discussions about earnings. I think we have to talk about McDonald's. The first sales slide, Lisa, in 4 years. Notable for that chain.
Especially as they talk about consumers that are being much more discretionary and the need for reliable everyday value. This came from their CEO at a time where they're extending their $5 value meal. That is one aspect that's been bringing diners back to the chain. We've heard this from a lot of companies. Understanding the broader significance, the trajectory of that weakening consumer, harder to understand.
The companies are saying things are slowing down. We're losing pricing power. You've got to ask yourself, where does the top line growth come from? Where's the margin expansion come from? They're going to cut costs? Does that mean pulling back on jobs? Will that start to show up in claims? Will that start to show up in the economic data we see on every first Friday of every month? Let's turn to the bond market. The 2-year last week rallying. Yields lower by double digits, down 12 basis points, down another single basis point this morning, 436.68. We're down 3 or 4, Lisa, on the 10-year, 415.89.
And this comes ahead of a really big week, and we mentioned this before, because not only do we get the economic data and the Fed decision, but we also get what debt the Treasury is going to sell at a time when a lot of people said that this will be the technical factor that really underpins how much of a premium there is. Look, I think that there is a sentiment of sort of buy the rumor, sell the news. It's sort of buying duration ahead of whatever could potentially happen, because the Fed is biased toward cutting rates, so you can't get burned too badly. That's sort of the feeling right now in markets, and you can kind of sense that as things sort of coalesce around some rate cuts starting in September.
I think last summer's quarterly refunding announcement was part of the trigger, part of the catalyst for the sell-off that we saw in debt going through to October.
Thank you. I like this. This is actually giving a sense of why this is important. It's true. This is sort of giving people a sense of the real world consequence of record amounts of borrowing by the U.S. government. Is this week going to be the trigger? We shall see.
I'm here to support you.
That was really kind.
That's why I exist. Marvin Lowe was on a program, by the way, in the last hour. We talked about this a few times, but if you're just tuning in, it's worth pointing out again. He thinks the supply dynamics will reassert themselves as we go deeper into 2025. And his call on the 10-year might surprise you. He's not looking for the 3s. He's not looking for the 4s. He's looking at a return to the 5s 5.25% on a 10-year yield next year.
And he said that, you know, potentially they could not be the haven assets that they have been in the past. This is pretty dramatic, and that would really cause a reassessment of equity valuations as well. He's not in consensus, but he's not alone either. We've heard this from others as well.
Might upset some of those trades looking for a stronger Japanese yen. Certainly worked over the last few weeks. 4 weeks of yen strength for the first time in 2024. Dollar yen's down to about 153.77. The path to 150 seemingly on the cards if we get a strong tilt towards a rate hike. Lisa from the BOJ later this week.
Right now, the market's baking in about 2 rate hikes from the Bank of Japan this year. Unclear whether they are going to hike into September. That's kind of the base case, although not fully priced. The big issue for them is they're facing weakness. They're facing actually a sense that the consumer is getting exhausted by some of the increase in inflation. So how do they toggle between a currency that's depending on them normalizing and a consumer that may be running out of steam?
Dollar yen right now, unchanged, 153.76. Under surveillance this morning, some top stories for you. Donald Trump embracing the crypto world. Trump telling a Bitcoin conference he will fire SEC Chair Gary Gensler and replace him with someone who, quote, loves cryptocurrency if he's re-elected. Trump returning to Butler, Pennsylvania this Wednesday, a little over 2 weeks since an attempt on his life at a rally there. Kamala Harris will be heading to Georgia. Where did this all come from? What's it all about?
Lots of money in the crypto world.
Campaign donations.
I mean, that's what a lot of people are saying. I'm just looking at some of the people who are now supporting him. It includes, of course, Elon Musk, as well as Tyler and Cameron Winklevoss. He was talking about how they look like models, but they actually have brains. And they also have venture capitalists Mark Anderson and Ben Horowitz. Those are some of the people who are starting to back him as he talks about tech prowess and as he talks about supporting the crypto world.
Is he implying that people who look like models don't often have brains? Is that where he's going?
I don't know what
it's highly controversial stuff.
Okay, thank you. Is that really what you, is that how you'd like to?
It's my takeaway.
Thank you.
Let's turn to this story.
Just, I
can move on. Let's get to political tensions flaring in Venezuela. As President, this is a hard turn. President Nicolas Maduro claims an electoral victory with just over 51% of votes compared to 44% for his rival Edmundo Gonzalez. The opposition party members are disputing Maduro's win, saying they've accessed 40% of the tabulated votes, showing Gonzalez winning 70% of the votes so far. So shock horror, dictator says he's won election. Now comes the challenge.
Yeah, especially at a time where Secretary of State Tony Blinken came from Washington saying serious concerns that the results announced do not reflect the will of the Venezuelan people. The international community is watching this very closely and will respond accordingly. What I find interesting, actually, is that the U.S. has actually been more friendly toward Venezuela recently than they had in the past, in part because of oil and gas. So, I mean, it just sort of is interesting at this moment when elections very much matter and are reshaping a lot of the diplomatic venues.
In a big, big way. Let's turn to the earnings. I know you want to do this anyway and sort of move on from the politics. Big week coming up with 4 of the Mag 7 reporting. Microsoft kicking things off tomorrow, followed by Meta, Apple, Amazon, Wednesday and Thursday. And now Bloomberg reporting this about Apple. Apple's upcoming AI upgrades will be delayed. Bloomberg's Ed Ludlow joins us now for more. Ed, good morning.
Good morning. Where do you want to start?
On the East Coast. I think we have to start with that Apple story, front and center for us. Are we saying that a new phone comes out in September, but it lacks the goodies?
It's really important to remember that the big run-up in Apple shares year to date or more recent performance was predicated on the hopes that this is it. We're going to finally get Apple's offering for generative AI. It's called Apple Intelligence. What Mark Gurman reported is basically chronology. So in September, you're going to get the new generation iPhone, 16, 16 Pro. And when they announced Apple Intelligence, they said that's when we'll give it to you with the new generation launch of that phone of iOS 18. What Mark is reporting is that they're going to kind of stagger it. They're going to say, okay, well, you'll get the new iPhone, then you'll get the new OS, iOS 18, and then several weeks after that, we're talking a matter of weeks, it's a delay of weeks, we will make this available through an update.
So tough question, why do I want the 16?
It's always a tough question. It's a good question. You have to decide how much in any given upgrade cycle you care about, I guess, incremental improvement in speed, processing power. I got an iPhone 15 Pro, it's pretty fast, fine for me, and camera. You know, that's the main point. You go to the root of the problem and the question. We're waiting on the software, ironically, this time around. And if you're impatient and you're an investor that's nervous about the Apple story in AI, you got to wait a few weeks longer than expected.
Not to be skeptical, but isn't part of the whole upgrade? Thank you, I appreciate that. Therapy on a Monday. You know, how much of people buying the new iPhone is because it looks cool? Because you can show the gadgets and the different types of attributes to your friends. How much can AI really add on that front at this point, given where it is?
It's a really interesting story, and it puts to the question of how much faith you put into third-party data. And I say that because when Apple reports earnings, usually the opposite of what the third-party data has proved true. That said, in the first quarter of this year, there was a lot of evidence that the Chinese consumer, for example, was very satisfied with the iPhone 15 generation. You know, in surveys and the shipment data, it would indicate that they'd bought it, and that would be it for quite a long period of time. You wouldn't come back and buy annually a new generation of iPhone. The other interesting point of difference is that Apple Intelligence is going to be available from, I believe, the 15 hardware generation anyway, meaning you don't have to absolutely buy the 16 to get to it. Your existing handset's fine. It's all strategy from Apple, and I think that most people would say they're satisfied. You don't spend handset or hardware money to get AI tools. A lot of people in the consumer use case are going with what's free. It's a beautiful part of the Microsoft story, right? Microsoft's been really good for a really long time, even before I was born, at selling software that you could otherwise just get for free. And that's where we are right now in how humans use generative AI. I like using it, but I'm not willing to spend. And I think that's going to be a big story for the rest of the year.
You mentioned Microsoft.
Yeah.
We're going to hear from Apple this week. Maybe they'll give some more guidance on this particular front. We're also going to hear from Microsoft. We're going to hear from Meta. We're going to hear from Amazon. We've been asking this all morning. How high is the bar for them at this point, given how punished Alphabet was? Tesla's is a bit of a different story, but Alphabet for simply investing more than people had expected.
Yeah, the story across all four of the names that report this week is very simple, that no one's yet able to say clearly for every dollar you've put in, how many dollars come out. And they all have a different way of putting it. So last quarter, Microsoft said they had 31% top-line growth in cloud, and 7% of that growth came from AI sales. It's somewhat tangible. They basically say, we expect you to invest, but we reserve the right to be disappointed if you can't give us something we understand. And that was really the story of Google last week, right? They said that year to date, they had made billions of dollars from generative AI and AI infrastructure. That's another way of saying we made money basically for the business of cloud that does both of those things, but we're not going to quantify for you specifically how much came from the generative AI side. In other words, how many dollars came out for the infrastructure investment they'd made, while infrastructure came in higher than the street was expecting.
If you could have any of the earnings right now, which would it be?
So the reason Alphabet was so good that it went first is that it told us everything about everything. They do cloud, but search is their core business, right? And so the street looked at it and went, hold on, I thought this was about AI, and you're telling me the thing you've always done is still your most important thing. That makes Amazon really interesting for me. AWS has a revenue run rate of $100 billion and a revenue run rate of billions in generative AI, but increasingly advertising has become important for them, and we get a gauge on the consumer. You kind of get everything, and you probably don't get that with Microsoft. Microsoft sells software. They've always sold software. They're quite good at it. You don't really learn that much from it as you might learn from Amazon.
Ed, it's good to see you. You're here all week?
I'm here all week. Thank you for having me.
Looking forward to covering the stories with you. Ed Ludlow there from the West Coast, now on the East Coast for the next week or so to break down some of these earnings. Equity futures right now on the S&P positive by about 0.5% with an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Speaking of earnings, McDonald's shares up slightly, 0.6% in the pre-market. Sales declined for them for the first time since 2020 from international to U.S. locations. Each of McDonald's geographic footprints saw sales decline for an overall drop of 1%. The estimate was for a 0.8% growth. The company's CEO said consumers were being more discriminating with their spend. McDonald's and its competitors are now offering discounts to try to lure customers back in. McDonald's latest is a $5 meal deal that it launched last month. And Chinese tech company Xiaomi has purchased a plot of land in Beijing for over $100 million to expand electric car production. The move follows the early success of its debut sedan. Xiaomi first entered the auto sector in March and has already delivered 30,000 vehicles so far. The company's on track to reach its initial goal of 100,000 cars by November. The company is perhaps better known for its smartphones, but it's also aiming to bring an SUV similar to a Tesla Model Y to market as early as next year. Disney's Deadpool and Wolverine has shattered box office records this weekend, bringing in $205 million. The buddy superhero film scored the best ever opening for an R-rated film, with more than twice the ticket sales of 2019's Joker during its first opening weekend. The latest entry in the ever-expanding Marvel Cinematic Universe continues Disney's hot streak this summer after Pixar's Inside Out 2 grossed almost $1.5 billion since its June release. And that's your brief, John.
Disney needed some good news. That's some good news. Thank you very much, Danny. Up next on the program, too little, too late.
I think the Fed should have been cutting earlier this year. Reason being that they've achieved their objectives. The labor market's feeling a little squishy here, and again, why take a chance? Mission accomplished. You've achieved your goals. Let's get going.
Get a move on. We've heard that on repeat, haven't we, over the last couple of weeks? They're not going to get a move on, based on what they've told us going into Wednesday. That debate is up next from New York City. You're watching Bloomberg Surveillance.
The top names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
I especially am afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Or other authorities.
Could face bigger challenges next.
Fed was going to keep rate while this is a three.
As the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Equities right now on the S&P, positive by 0.4%. A little bit of a bounce continues. Yields lower by 3 or 4 basis points. The 10-year 4.1569. Under surveillance this morning. Too little, too late.
I think the Fed should have been cutting earlier this year. Reason being that they've achieved their objectives. The counter is, well, nothing's going wrong. Well, really, you're going to wait till something goes wrong before you start cutting rates? Isn't that too late? The labor market's feeling a little squishy here, and again, why take a chance? Mission accomplished. You've achieved your goals. Let's get going.
Here's the latest. The Fed expected to set the stage for a September rate cut when it meets this week. But some market participants are wondering if the central bank is behind the curve. Amanda Lynham of BlackRock is in the September camp, and she joins us now for more. So, Amanda, we've got Moody's saying get a move on. We've got Bill Dudley saying get a move on. Mohamed El-Erian saying get a move on. What's the excuse to wait?
Good morning. Thank you for having me. I don't think there is a strong sense of urgency for the Fed to cut given where growth is, but at the same time, we are seeing loosening in the labor market, weakening in the consumer. In addition to the earnings that you've been citing this morning, you have the Philadelphia Fed credit card data that shows consumer delinquencies on credit cards at a 12-year high. So that bifurcated low end of the consumer really is feeling the pain. And so I do think the Fed's been communicating this kind of pending rate cut for a long time. In inflation has been moving in the right direction really since April. So we certainly see the case for them to kind of tee up a rate cut in the July kind of commentary and then move forward with it in September. I think the question, though, really is what is the depth of this rate cutting cycle? So how far do they go? How much relief, for example, does that give consumers and corporate borrowers? And then also, again, the drivers behind this rate cutting cycle are really important. Are they cutting urgently in response to deteriorating growth and deterioration in the labor market, or is it really just kind of normalizing monetary policy?
This is a difficult question to answer, but just explore it with us. Where would you look for in credit to sort of discount some of these issues that might be on the horizon? Because credit spreads, Lisa and I have been going back and forth on this for the last couple of weeks, they're super tight. They say there's nothing to see here. There's no growth scale whatsoever. Is that right?
So there are some pockets of vulnerability. High yield spreads, 306. Well below the post-financial crisis average. But there, in addition to the kind of well-telegraphed themes that many talk about, there's one point that I think is really important and kind of explains some of this resilience in credit spreads, and it's unique to the cycle. It's that companies are staying private for longer. They're staying in that kind of private lending ecosystem for longer. So by the time that they get to the high-yield market, they're larger, more diversified companies, and I think that is a defining feature of this cycle. But to your point, Jonathan, triple Cs are showing this. They've not kept pace with the overall rally in the broader high yield market in terms of spreads. And even within triple Cs, there's a lot of bifurcation. There's some triple Cs that trade at 700 and some triple Cs that we refer to as almost broken capital structures, and they trade much wider than that.
I want to dive into what you just said, which is that companies are staying private for longer. And it raises this issue, are you going to see the distress in a more pronounced way first in the private credit sphere before you see any disruption in the public markets?
It's a great question. I think the important offset is that the underwriting process in the private markets and kind of the structuring is very different than in the liquid market. So these are exposures that are held on kind of one lender or a few lenders' balance sheets. They're held in size. They're held for the maturity of the loan. I do think it's going to be difficult for new entrants in private credit that don't have kind of incumbent business models and perhaps workout expertise. So I don't think this is a rising tide lifts all boats, that all private credit lenders will be insulated. But the important thing is the growth backdrop supportive? Our view, and this is true for both liquid and private credit, is that you need either trend or above trend growth as a prerequisite for the ongoing resilience that we've seen. So that is really what we're looking for. We're not expecting material near-term interest rate relief. And so given that, you need the growth backdrop to kind of play along to keep profits and margins elevated, and they're already getting squeezed. So that's what we're watching. But just to circle back to the high yield spread comment, I think it shows that this cycle is so unique because we often look to kind of the 90s and the early 2000s. The credit markets are completely different. I think the best analogy you could make in terms of valuations in credit is mid-2021, where that was kind of the local peak for spreads, both in IG and high yield. But keep in mind that yields were much lower then. So actually, the yield-based buying that's happening today is a strong tailwind for spreads, and we're even wider than those mid-2021 levels today. And in 2021, we didn't have the yield support. So I think there's a significant opportunity cost for being materially underweight credit at the moment.
Are you saying that credit can no longer be the canary in the coal mine? That essentially you could see a rolling over in some of the economic activity without necessarily commensurating credit spread widening just because of the good balance sheet situation?
I think the case for broad-based deterioration in corporate credit is a bit difficult. I think the bar for that is very high. Our kind of theme for the past few quarters actually has been dispersion, but not widespread market disruption. So I think really the most likely outcome is that you see these kind of canary in the coal mines in certain issuers, certain sectors, parts of the high yield market, parts of the private credit market, parts of the leveraged loan market. But broad-based deterioration, I think, is difficult because the cycle is just so unique. You've got technical tailwinds from most of the supply being refinancing related, so not a lot of new money, yield-based buying, a third viable option of funding in private credit, and 2.8% GDP growth. So even if we slow from here, we're probably still at trend. I think that's really the key to watch is the growth backdrop.
I just want to understand if this is what you're saying. What I hear is that spreads can remain tight for longer than you think because the all yield opportunity is just so great right now compared to where we've been previously.
Yeah, and not exclusively for that reason, but coupled with the fact that corporates entered this period from a pretty solid balance sheet position. And then, of course, you have this kind of other viable funding market in the private markets. And then also the technicals have been supportive in terms of supply. So yes, there's been a lot of supply in high yield and leveraged loans, but it's actually been skewed towards refinancing. The other thing that gives me comfort is corporates are now chipping away at late 2025, early 2026 maturities. So when you think about kind of high yield possibly widening or IG even widening, you kind of go to what's the catalyst. I think it's unlikely to be a payment catalyst because the balance sheets are in such...
So that maturity wall scare of next year, survive until 25, we put that story to bed?
I think, yeah, I mean, I don't know if it's to bed for every single corporate because there are some, I would say, again, CCC, really kind of lower quality issuers that are struggling in some instances to kind of shore up and get into a sustainable capital structure. But corporates have made great progress on it, and I think appropriately so. They've capitalized on the strong tone.
And looking right now at the all-in yield for high-yield bonds, it's 7.6%. It's close to what it was back in mid-2022, so it's about the lowest levels going back 2 years. If the Fed cuts rates, does that actually make financial conditions easier? Does that actually lead to lower borrowing costs for companies from here? Or are we kind of stuck here for a while, one way or another, that spreads can compensate for any decline in yields?
If the Fed cuts rates, I think what it could do is bring some of that cash out of money market funds and kind of deploy it into longer term maturities. For corporates, I think they've been appropriately issuing irrespective of the rate environment. So if we get a 25 or 50 basis point cut this year, I don't think it's game changing for high yield corporates. I don't think they suddenly rush to issue. And in fact, the commentary from some of the large banks with debt capital market syndicate operations has actually said that the activity in the first and second quarter was a pull forward from later this year, possibly to get ahead of event risk. So I actually think the calculus for corporates when they're issuing has been less about the rate environment and more about how can I shore up my balance sheet, how can I be proactive, and I think that's appropriate.
Amanda, as always, just a fantastic breakdown. It's good to see you. Amanda Lanham there of BlackRock, just on the resilience of credit and the reasons for that resilience.
And this has been the reason that people have pointed to why they're not nervous that there's going to be some sort of big sell-off or some big recession. They say, look how tight credit spreads are. Well, maybe credit spreads aren't going to respond as quickly. And this is the problem, is that maybe specific credit spreads will respond, but not broad-based because there are lots of different economies that are moving at different cycles post-pandemic.
It's not the credit market of 15, 20 years ago. I think it's fair to say, right?
It's not your grandmother's credit market.
Is that how old your grandmother is? 15, 20 years older than you. Come on.
Yeah, okay, good. No, I'm just saying. All right, no, I'm just saying.
307.
I know, okay, but, you know, back in...
You're aging people, okay? They were around for that. Remember that.
I was too.
Same here.
Okay.
Equity futures right now.
Thank
on the
you.
S&P, firmer by 0.4%.
How about those markets?
How about that market? In the next hour on Bloomberg Surveillance, a younger audience as everyone tunes out. Coming up, Kevin Gordon of Charles Schwab, Arun Sundaram of CFRA, James Camp of Eagle Asset Management, Zach Griffiths of Credit Sites. That's up next. This is Bloomberg.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're
in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
The market is not oversold yet. We think that this correction continues.
This is the problem that we're seeing. We don't have a consistent message coming from the earnings season. That's what's causing some of this volatility.
While there could be some stumbling, we are maintaining our overweight recommendation on tech.
There's likely this disconnect that's building between the earnings expectations and what's happening in the economy.
Ultimately, I think, the fundamentals matter. And I think the fundamentals sort of support this rotation.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance begins right now with a massive focus this week, once again, on the U.S. consumer. Just some of the highlights, some of the quotes we've had from corporate America over the last few weeks. From Nestle, there is value-seeking behavior among consumers. From Pepsi, in the United States, there is clearly a consumer that is more challenged. And from McDonald's this morning, they will focus on, Lisa, reliable, everyday value because diners have become more discriminating.
It's coming from every sector. It's coming from the airlines. We heard it from Stellantis' CEO last week that the goal is on cutting prices, on being competitive even with China, which they said had a 30% pricing advantage over them. Or cost advantage, I should say. Here's the issue. At what point is this just a tempering of the massive run-up in prices and, frankly, pricing power that we've seen from some of these companies versus a real beginning of a softening cycle led by the consumer?
Which is why Mohamed Al-Arian says cut interest rates this week. It's why Mark Zandi of Moody's says why take the risk, make a move this week. It's why Bill Dudley, the former New York Fed president, says get a move on. Then you separate those calls and you look at the economic data and you look at jobless claims and where the labor market still is, and you ask yourself, is there a rush?
Especially at a time when you're not necessarily seeing broad-based layoffs in response to shrinking profit margins that we were talking about. It's unclear because as one person, as Mark Zandi was saying, do you really want to wait till something breaks? Do you really want to wait till we see the pain, at which point it's going to be too late? There is an added point here, and this is what I very much want to hear from the Fed chair this week. How much are they trying to loosen the pressure for the lowest end consumers, which are actually showing some real strains and will be arguably affected by a lower borrowing cost on the front end, most directly considering that companies have already locked in pricing and won't necessarily feel it in the same sort of manner. So those are some of the considerations I expect to hear.
Which is why for this story specifically this week, I'm not so much interested in the Federal Reserve decision, the BOJ, the Bank of England. It's all important. But there are other things that I think are more important for this conversation exclusively, and it's payrolls on Friday. And we've gone over this repeatedly. Payrolls on Friday is going to be the difference between the right kind of cuts and the wrong kind of interest rate cuts. If you're cutting interest rates because jobs are okay and inflation's come down enough, good stuff. If you're cutting interest rates because unemployment's getting away from you, that's the wrong kind of interest rate cut this September. And that's going to be the difference going forward from here. Every first Friday of the month for the next several months, where's payrolls? Where's unemployment?
And when you say the difference, it really determines whether rate cuts are going to spur a risk rally or whether it will spur a risk sell-off. That is the distinction here, because if you get rate cuts in response to real weakness, that will signal there is a problem. These stocks, these corporate bonds aren't going to do as well and people will sell. If it's just to simply prolong the expansion, well, let's go back to the party.
Too little, too late, or back to the party? That's the conversation this morning and through the rest of this week, I guess. Equity futures right now on the S&P 500 look like this, or the rest of this year, who knows? We're up by 0.4% on the S&P. We're down 4 basis points on a 10-year. The rally in treasuries continues. Double-digit decline at the front end of the curve last week. The 2-year down 12 basis points. Just keep chipping away, shaving away at that yield across the curve. The 10-year down to 4.15. And an announcement on supply, quarterly funding, later this week as well.
Yeah, people are expecting them to come out. Today, they're going to give an estimate of how much they're going to borrow. And then on Wednesday, they'll break it down in terms of which denominations. And this comes at a time where, John, you were talking about activist Treasury issuance. If the Treasury starts to issue more at the long end of the curve, how much does that actually prop up prices or prop up yields, lower, suppress prices on the long end, leading to a bear steepening? This idea that the long end is seeing a sell-off in response to supply issues, not because of a dramatic amount of growth, and front end really getting a rally.
Peter Schiff Academy saying supply would reassert itself. Marvin Lowe of State Street early this morning saying the same thing. Marvin Lowe, a 5-handle again on a 10-year. That's his call for next year.
That's pretty bold. Can you imagine what stocks would do if there was really a 5.25% 10-year yield?
Tell me where the economy is, and I'll tell you what stocks would do.
All right, Janet Yellen.
If we've got unemployment closer to 5 and yields are 2, we've got a big problem.
Yeah.
A big problem. Coming up this hour, we'll catch up with Kevin Gordon at Charles Schwab on why he says the great rotation will continue. No one's ever called me Janet Yellen. Aaron Sundaram, that was delayed, I know. We'll catch up with Aaron Sundaram of CFRA as consumers start to pull back. And Zach Griffiths of Credit Size on why the market is pricing in a dovish hold for this week's Fed meeting. I'm sorry, Janet. We begin with a big issue, the cusp of correction, a turbulent rotation out of big tech, dragging the NASDAQ down 8% in just over 2 weeks. Kevin Gordon of Charles Schwab seeing that rotation continuing, saying this: the normalization process will continue to pull up the laggards, but it won't be smooth. Much of this is now starting to take place given the recent snapback in small caps. Small caps are really just doing what they were supposed to do more than a year ago. I'm pleased to welcome Kevin to the program right now. Kevin, good morning.
Morning, guys.
It's great to see you, sir. Let's start with this. Just your framework for thinking about things at the moment. Rolling recessions, rolling recoveries. Is that how you still view things?
Yeah, it's still how we view things. And, you know, for the most part, it's kind of kept up with how the economy has evolved this year. And it's been a choppier process, though, for the recovery part. So when you think about areas of the economy that went through their own recessions, manufacturing, housing-related consumer goods, in that 2022 to 2023 period, those have now started to enter recoveries, but it's been choppy. So manufacturing's been choppy because of the turn lower in some of the ISM and some of the regional Fed data. Of course, the consumer's been under, you know, still some pressures you've all been talking about today. And then now you're starting to see it morph a little bit into services. And this is now the point where I think we really start to see, you know, more meat on the bones as to how much the services hit is really going to take down the broader economy, or if you can get that nice kind of roll through on the manufacturing side, and it's just a softening in services, and then you kind of keep everything afloat. So to the normalization part on the market's part, I think that in our view is still that you've got these laggards that are more cyclical in nature, that are smaller in nature, that really struggled as the cyclical parts of the economy, you know, struggled, and then now they probably have more runway to at least normalize or catch up a little bit.
So let's talk about the service industry first. Surprise for us all, I think, was the airlines. We came into this quarter, we all went to the airport, busy, went on a plane, packed, and then Delta, United, American all came out and said it's not as good as you think it is. What did you make of all the commentary we've heard from the service industry?
You know, I think it's tough because now you're at a point for especially the labor market where things have started to soften. You've seen not only on the demand side, you know, things start to cool, but that's morphed into now just overall aggregate income growth cooling as well. And it's not this Armageddon scenario where you have to automatically start comparing to prior recessions like the global financial crisis or even to some extent the tech bust, which in GDP terms or, you know, labor terms was not that, you know, cataclysmic. But I do think that some of the discretionary spending and the choices that consumers are starting to make and being a little bit more selective and decisive on where they put their money, that's become, you know, a bigger part of the story. But I think we also have to keep in mind, in many ways, we've been calling this year sort of a tale of two markets, but there's also been a tale of two economies, especially on the consumer side. You look at inflation within CPI for non-discretionary versus discretionary items. The non-discretionary items, that annual inflation rate is still running in the 5 to 6% range, but if you look at the discretionary items, it's basically flat. So I think because that you're now starting to see that income growth slow and consumers are having a little bit of a harder time, you know, especially down the income spectrum, deciding where they're going to put their money, even if they're still fully employed, it's just a choice that they're making and being more selective.
You have a pretty contrarian call. You said that if we look at certain traditional metrics, we're actually in a recession.
Well, it's if something like the unemployment rate itself, you know, one of the, I think, cycles you could look back to, not saying that this is a repeat by any means, but what's interesting to me and one of the most fascinating recessions to study is the one that was from 1973 to 75. For the first 9 months of that recession, payrolls were positive. Payroll growth was actually positive. It was decelerating, but you were still adding jobs, even as the unemployment rate went up from, you know, mid-4 to mid-5%. You didn't start to get that waterfall in payrolls until the very end of that recession. So it kind of speaks to the fact that, yeah, we have seen a move up in the unemployment rate this time. It's been more driven by, you know, an expanding labor supply, although that's typically what happens, you know, even in a recession. But if you're going into one, or if we're going into one that's a little bit more traditional in nature, then you're by definition already in it, because that's what, you know, the peak is when the sort of the NBER goes back and dates the start of the recession. But again, I don't think it needs to be this, you know, sort of bombastic, we're going into an epic recession. You've had some that are a little bit more mild in nature. You've had some that are a little bit more severe. The ultimate trouble with this is that the sample size is just not that, you know, not that large.
I like how you try to talk down the analogy of suddenly heading into a 1970s style recession, because a lot of people will start extrapolating out, okay, stagflation, and it becomes hyperinflation, and all of a sudden, how do we get out of there? At this point, is the bigger risk the deceleration on the labor market, or is it a stickiness in inflation that creates a sort of, I don't know, something that rhymes with 1970s?
Yeah, I think the risk, and rightly so, and the Fed has been pointing to this, and all the Fed speak has been pointing to this, is probably that the labor market's becoming more of the issue that they want to be able to, you know, at least get ahead of, even if it's a couple of rate cuts and hopes to get there. I think that they're trying to signal us in that way. And, you know, this is the part where you try to figure out and suss out what's the actual inflation rate that they become more comfortable with. Yeah. They're not going to, you know, Powell has said it many times, they're not going to wait to get to 2% year over year on PCE or core PCE until, you know, it's mission accomplished. But, you know, the labor market becomes more of, I think, a dominant piece of the puzzle at this point. And it's a very different scenario, you know, even just 6 months ago when you had all of these inflation metrics, whether you annualize them on a 3 or a 6 month basis, that were showing we were at 2%, but the labor market was still relatively tight. Now you're in a position or at a point where the labor market's just not as tight. So I think they have a little bit more room to work with there.
The destination we're going towards, I'm just thinking of lower interest rates potentially, lower growth maybe, and higher unemployment rate. It doesn't scream cyclical, small caps and banks. It kind of says, shouldn't we be buying tech?
Yeah, I think that's one of the reasons where, you know, we think that this rotation, if you want to call it the Great Rotation or the Great Reaction, whatever you want to label it, you know, I think it has room, but probably more for the profitable and high quality parts of the market, because when you look at that initial, you know, thrust after, you know, post-June CPI report, it was kind of an everything rally for an index like the Russell 2000. Now that has started to split a lot more, where even if you go over the past year and you use just one criterion of profitability, whether companies have profits or not, the profitable group is up by almost 20%. The non-profitable group is basically flat. So you have seen, you know, on the part of the market and investors, you have seen more selectiveness when it comes to that index, and I think that will probably continue. But again, I think it's more of a normalization because we have to to keep in mind, the Russell 2000 is still not back at its November 2021 high. So if this was the case where we were just ripping from those highs and you were at a same stage or in a similar state as the S&P 500, then I think it would be a little bit more worrisome. But right now it seems a little bit more reactionary. And again, to your point, staring down the barrel of a labor market that's still softening and GDP growth that's still cooling doesn't make a whole lot of sense to me as to why small caps would automatically just rip the baton from large caps.
Kevin, this was awesome, and I have to say this line in your note was music to Bramo's ears. Life is simpler when you keep politics out of investing. Did you like that too?
I loved that line. He wrote that several times, which I really relate to.
Shows you how I feel about that.
Yeah. I mean, like, I think you were basically like, please do not ask me about it because I will not answer.
Talk about it.
You're in good company. We'll let it go. Kevin, it's good to see you. Fantastic. Thank you, sir. Kevin Gordon there of Charles Schwab. Let's give an update on stories elsewhere this morning with your Bloomberg brief. Let's get across to Danny Berger. Hey, Danny.
Hey, John. Israel attacked Hezbollah targets on Sunday and threatened further retaliation for a rocket strike that killed 12 children. Israel also signaled openness to a proposed Gaza truce that could calm the second and more combustible front with Lebanon. Prime Minister Benjamin Netanyahu returned early from a U.S. visit where he was seeking to drum up support. Netanyahu's office said the prime minister held back-to-back consultations with military chiefs and the security cabinet. President Biden will call for term limits and ethic rules for Supreme Court justices later today. It's part of a sweeping new proposal, which also calls for constitutional amendments to ensure that former presidents can be tried for crimes committed while in office. Democrats have increasingly called for reforms to the court amid recent controversies. However, passing the plan faces a difficult path, requiring support from the GOP-controlled House. And it was an eventful opening weekend at the Paris Olympics. Simone Biles and Suni Lee stole the show for U.S. gymnastics, both qualifying for the all-around final. Kevin Durant powered USA basketball to a win over Serbia, and the U.S. secured its first gold with the men's 4x100-meter freestyle relay. The U.S. is leading the overall medal count with 12. 3 of them are gold. China has 5 gold medals and 9 overall. And that's your brief, John.
Danny, thank you. I like my Olympic medal table. Population adjusted. Australia, always punching above its weight. You seen that?
Especially in swimming.
It's amazing.
They're incredible. Well, it's like a good build.
When you go on vacation, notice who's up first. It's always the Australians. You ever noticed this? They've already done a hike by the time you've sat down for breakfast.
It's true. They tend to be very
outdoorsy people.
I feel like we're going to get in trouble for this.
No, it's a real thing.
Okay, I know, but it's true.
Do not deny me my real life experience, all right?
Please, I won't.
Okay, it's my lived experience of my vacations. Australians are up early. They're fit. That's what I see all the time.
Congratulations,
and the Olympic table backs that up. Up next on a programme, the morning calls, plus Aronson Durham of CFRA as consumers pull back on post-pandemic revenge spending. That conversation up next from New York. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
So much love now for Australia for good reason. Equity futures right now on the S&P look like this. We'll get back to the markets. We're positive by 0.4% on the S&P 500. Let's get you some morning calls. First up, Morgan Stanley naming Tesla as its new top pick within the US auto sector. The analyst maintaining an overweight rating and street-high 310 price target, citing cost cuts and restructuring that have helped to restrict the downside to Tesla's EV business. That stock is up by 1.7%. Your next call coming from Citi, raising its price target on 3M to 133 and keeping a neutral rating. The analyst saying upside to second quarter earnings and a modestly raised 24 outlook are encouraging signs of relative stability. Stock is still lower by 0.7%. And your third and final call from CFRA upgrading Dollar Tree to hold with a price target of 109. Analyst Arun Sundaram seeing softness in its Family Dollar brand and risk tied to Dollar Tree's multi-price point strategy. Aaron joins us now for more. Aaron, let's get straight into this, sir, and thank you very much for being with us at a time when the consumer is very much front and center in our minds, and we're trying to work out how different companies are gauging where this consumer is at the moment. Earlier on, we heard from McDonald's, and they say maybe this consumer is slowing down. We heard a similar story from the likes of Nestle, from Pepsi too. In the companies that fall under your coverage, what do you see?
Hey, yeah, thanks for having me. Yeah, we're also seeing a slowdown in spending. I think what's a little funny, in my coverage, I cover a lot of big box retailers and packaged food companies. A lot of these retailers have been seeing a slowdown in spending for the past 2 years. But I think we're talking about it more now because you're also seeing weaker spending in the services side of the economy over the last say a few quarters or so. But really spending on goods has been soft for probably the last 2 years, especially spending on discretionary goods, especially those bigger ticket discretionary items. And now that we're seeing a softness in the services side of the economy, we are talking about the softening of the consumer a little bit more. But we're seeing the same things. Consumers are trading down. They're opting for cheaper private label brands. They're even opting out of certain categories. In some cases, they're just being very choiceful, discerning in their spending. But like I said, that's been the kind of the trend for the last year to 2 years now for at least the big box retailers.
Well, it certainly reminds me of the difficulties that the likes of Target had over the last couple of years. If I go through some of the other companies in your coverage, Amazon, Walmart, Costco, when I hear trade down and more choiceful consumer, I think Walmart. Is that the winner in all of this?
Yeah, certainly. Walmart has been our top pick in the retail space for the last year and a half now. Walmart is gaining a significant amount of market share. Not just in grocery, which is what they're predominantly known for, but also in their general merchandise categories. You don't really think about Walmart as being like an apparel retailer, a general merchandise retailer, but they're really growing out that general merchandise business, and predominantly because of their e-commerce platform is growing pretty significantly. They introduced a Walmart Plus subscription program. These are all high margin businesses for Walmart, and on top of that, Walmart's also growing out their advertising business, something that we don't really talk about a lot with retailers. But the advertising arm for many of these big box retailers are growing attractively, and that's a much higher margin business than selling core goods. And that's why I think that the stocks for a lot of these big box retailers are up, and I think a lot of it has to do with the fact that sales mix is changing, and they're not just being known for a goods retailer anymore. They're selling advertising, it's healthcare, it's financial services, and like I said, these are much higher margin businesses than goods.
And Arun, this is the reason why it's sort of a question of how do you get a view on the true consumer. Maybe Walmart isn't the cleanest read because of all these other types of businesses. Certainly Amazon isn't because of AWS, et cetera. With Dollar Tree, is what's good for Dollar Tree bad for the rest of the economy? Is it typically that when those types of companies do well, it signals real weakness for the rest of the consumer spending space?
Well, I mean, in fact, both these dollar stores, Dollar General, Dollar Tree, they've actually been struggling more than other retailers over the last year. And why? It's because they're more exposed to that lower income household, which, as you know, is a little more exposed to the effects of higher inflation, higher interest rates. It's really the retailers that are more exposed to that middle income or higher income consumer is doing much better. So yeah, I wouldn't say that dollar stores are doing well in this environment. They've actually been I would say struggling in this environment. It's Walmart that's really gaining market share at the expense of these dollar stores. But our expectation is these dollar stores will start to recover. I think in the second half of this year. With Dollar Tree specifically, they're like I was saying before, they're introducing this multi-price point strategy in their stores. and introducing new price points, that's, and I want to make it clear, it's not because they want to raise prices. They just want to introduce new assortment in their stores. So for Dollar Tree, 80% of their goods are still going to be at that entry level $1.25 price point. Just 20% of their goods are going to be at these higher price points, $3, $5, $7. That's a way to attract more consumers into their doors. And early signs are showing that it's a success right now. These stores where they have these multi-price point products, the consumer basket size is actually 2 times larger. So people are putting more items into their basket when these stores have these multi-price point products, which is great because we're right now in an environment where basket size has actually been shrinking because people have been putting fewer items in their basket. But for Dollar Tree, it seems like, at least with the stores that they have this multi-price point strategy, people are putting, more items into their basket.
I've been waiting for them to rebrand as $5 Tree, but evidently that's not happening. I am wondering, when you talk about Walmart and the likes of actually really gaining on advertising and on some of the online spending, how much they're actually winning market share, not just from other retailers, but from Amazon, the one that kind of coined the whole kind of online marketplace.
Yeah, I mean, Amazon's the big, gorilla in the room, especially in the e-commerce space. And now other retailers are, really trying to catch up. Walmart a few years ago introduced Walmart Plus. That was their subscription program intended to compete against Amazon Prime. We think Walmart Plus is so far been successful. Walmart doesn't necessarily release membership statistics on Walmart Plus, but we do see that, Walmart Plus subscription base growing. Even Target, they're a little late to the race here, but just a few months ago, Target introduced their own membership program called Target Circle 360. Memberships are really a way to drive consumer loyalty and drive traffic into their stores. And it's also a way to grow margins and reinvest in your business. So I think, you're going to see more retailers try to offer these membership programs. The problem is that, how many memberships can a consumer subscribe for? So there's clearly going to be some winners and some losers. I think the retailers that are going to be winners are the ones that have a very wide assortment of products. So the Amazons of the world, the Walmarts, Costco is they're also a subscription program given their warehouse model. But I also believe Target is also going to be a winner of the subscription program. And like I said before, these subscription programs is also a way to grow your e-commerce business, which also will help you grow your advertising business. And right now, advertising is where the margins really lie. And these retailers are really leaning into their advertising business to try to help grow profits.
Just amazing. Just an amazing turnaround. I appreciate the update, sir. Arun Sundaram there of CFRA. Just kind of frame it at the end there. How much of a challenge these companies have become to the likes of Amazon to hear the advertising business. And I know we've heard this before, but the ad business becoming a bigger part of some of these companies.
Yeah, and Walmart's really been ramping up its online presence in a much more significant way. I love how some of these consumer-facing companies are increasingly anything but consumer-facing companies. Airlines are actually credit card companies. You have Walmart, some of the retailers are actually advertisers. It's sort of like, it's not really good to just be consumer-facing. We also have 15 other businesses. Check them out.
Things have changed. Things have changed a lot. Equity futures right now positive by 0.5%. 1 hour away from the opening bell. The lift continues. We'll catch up with James Camp of Eagle Asset Management and Zach Griffiths of Credit Sites. We'll catch up with them just after the commercial break. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
So I mentioned this stat on Friday, and if you missed Friday, you went to the beach early, good for you. I'll repeat it again. This is for you guys. The Mag 7, this is from Deutsche Bank, Mag 7 down 12% from its peak 2.5 weeks ago. The Russell 2000s outperformed it by around 25 percentage points over that period. Jim Reed, Deutsche Bank. That just kind of frames how vicious this rotation has been over the last few weeks.
And some people say it's just simply because we're dealing with how underpriced some of the small caps have been versus, say, some sort of statement on this incredible growth wave. Other people say this is the beginning of a really good period of time for the cyclical stocks at a time where the Fed's going to be cutting rates.
Can it continue? It continues this morning, up by 0.8% on the Russell. The small caps continue to rally. Large cap tech does all right as well. The Nasdaq 100 up by 0.8% on the S&P 500 up 0.5%. A massive week for big cap tech. Some big earnings tomorrow. Microsoft, Wednesday, Meta, Amazon and Apple coming on Thursday. Switch up the board and get to the bond market. The 2-year big rally last week. Yields dropping 12 basis points. We drop another single basis point this morning. 437.50. It's not just the Federal Reserve decision on Wednesday you've got to confront. It's the data through the week, including payrolls on Friday.
You nailed it. The good kind or the bad kind of rate cut. Because at this point, we seem to be having this you can have your cake and eat it too kind of moment. Or some people would call it Goldilocks. This idea that the economy is softening, not soft. You're ending up with a Fed that's cutting rates proactively to expand the cycle, good for small caps, and lets yields go lower. What could potentially gut check it? Well, either a labor market that comes in weaker than expected, or the idea that issuance pushes up yields at the long end. You get some sort of disruption that kind of challenges some of the Goldilocks narrative that we've been hearing.
And if this wasn't enough, you've got to grapple with the politics as well, which is just as messy. Still can't figure out 25. Terry Haynes of Pangea came on earlier in the program, and he said basically in his notes that it's quite simple. He thinks that Harris wins and you have a split Congress and you can move on with life.
Okay.
I'm not sure things are ever this simple these days.
And then what does that mean for a policy perspective? I mean, what a lot of people in markets, great, you can come out with that. It's almost easier to talk about this poll is saying this and this person's doing this than, okay, what does that mean for markets? And we had, Kevin Gordon on, he just said, the best thing you could do is just keep politics out.
Everyone's calling it the honeymoon period. I think we're going to call it the relief rally of the Democratic ticket. Their stock is just rallying because the former CEO dropped out. Not my framing, someone else's. I can't remember who said that, but it's a great way of framing it. Now we need to see, what's your plan? What's your plan after you've had that initial bump?
Yeah, who are you bringing in, too, to be your running mate? How moderate will the person be, and which states will they be catering to kind of reshape? Are we talking about a blue wave that's important, the sort of Rust Belt states, or are we looking beyond that to other places as well? What happened to Andy Bashir? I mean, I don't know how The Bachelor works. I mean,
where did Governor Walz come from?
I mean,
where did that come from?
Maybe it's the wild card. It's like the wild round. What is it? I don't know. You're more familiar with Bachelor than I am.
No, you've been watching it too, haven't you? Bachelorette.
Some, yeah,
no, I just know the roses bit.
Yeah, I just know the roses, but I don't know how it's like selected.
There's a wild card round.
I don't know. I'm just making things up right now. Let's move on.
You can't make stuff up, Ramo.
Oh, come on.
It's important TV.
Yep.
Let's get to the FX market. Dollar yen, 153.95. What are you doing? Up by 1/10% on that currency pair. So we've got the Bank of Japan on Wednesday. This came from JP Morgan. They're looking for a hike to 0.25% at the BOJ, and they're looking for a big cut in bond buying as well. The key issue to watch may be the terminal rate level the BOJ has in mind and the time frame for it. Here's the quote from them. It will be a test of whether the BOJ will make policy decisions based on its assessment of the economy and inflation in a forward-looking manner, or will refrain from policy changes unless responding to immediate market pressure? What kind of BOJ have we got here?
Well, that's a great question. People are wondering how much they really got to cater to the yen versus worry about the fact that consumers are showing some signs of weakness. Really, the key is going to be, and this is Pantheon Macro, he's saying the balance sheet could potentially be the most important, Ian Shepherdson over there, because essentially they could stop buying so many bonds, but keep rates where they are, not hike them right now, and that might be sufficient for markets. We'll see. I think from a market perspective, the Bank of Japan might be more consequential than the Fed this week.
Possibly, given that they actually might change something this week as opposed to the Federal Reserve, who aren't set to change much at all, but we'll see. So we've got dollar yen down to about 153.93, just short of 154. Last week, that currency pair down by 2.36%. Down 2.36%, so that's the biggest week of yen strength that we've had going back to May of this year, I believe. Under surveillance this morning, our top story for you, one of them at least, presumptive Democratic nominee Kamala Harris raising $200 million in her first week as a candidate. This is a new ABC News poll, shows Harris's favorability rating rising 8 percentage points to 43% since President Joe Biden's decision to drop out a week ago, and now it's Veep stakes, so let's talk about some of the names. Governor Shapiro of Pennsylvania still in the running, Senator Kelly of Arizona still very much in the running, and then Governor Walz seemed to come from nowhere as a top three reportedly over the weekend.
Yeah, from Minnesota, which is a state that Donald Trump is going after. I am curious about what the goal is for one of these potential candidates to bring. Is it the idea of a more moderate voice? Is it just simply the location that they're in? Is it to try to bring in certain states that are on the fence? I'm curious how it's framed in terms of a ticket that is a policy prescription in some capacity, because people still don't have their head around exactly what a Kamala Harris presidency would look like and whether it would be different in any way, shape, or form from a Joe Biden presidency.
Things have changed a lot. When we were talking about the prospect of Biden still running, we were talking only about the Rust Belt. That was the path to victory. Then we had this conversation earlier this morning, I think with Gillette Lowe of Strategas, which basically talked about how we've opened up the Sun Belt again, and we can start having real conversations about places like Arizona, which speaks to Senator Kelly. I guess we'll see. Based on the conversations we've had repeatedly over the last week, feels like Governor Shapiro is still right up there as the leading candidate, but who knows?
Yeah, especially because Kelly has some experience with international sort of foreign affairs issues. I'm curious where the emphasis goes on that as well. But whether it's just simply a swing state or if it's something more in terms of policy, will be interesting to watch.
We had some news overnight on the Apple front. I want to bring that news to you. So the upcoming AI features are now expected to be rolled out just later than anticipated, which is all a little bit odd. So if you put it all together, we've got these AI features. You now have to wait for the software update that's going to come later this year, but you'll get the hardware update before all of that when the iPhone launches in September. Is that the right chronological order of things?
Yeah, the hardware update isn't that significant, and it's not that big of a stylistic kind of increase. It really was supposed to come from the software update, which would include some of this AI technology. Put it all together, there was one bellwether that we were watching, which is whether one Jonathan Ferro would actually upgrade his phone and buy into it, and that would be the trigger.
Big data point.
That would really signal that, yes, the upgrade cycle is beginning. And it sounds like there's some skepticism of the John Ferro schedule.
I don't think I'll be upgrading in September.
Oof, you heard it here first.
It's not going to have the goodies. But then once you get the phone, then you just wait, and then you sort of like, it gets updated, in a month later or something like that.
Yeah, I mean, you'll actually get the upgrades. But my question is, what are the upgrades? What will AI provide that you're not getting currently in search and other ways that we don't even realize we're having certain AI-infused programming? I don't know exactly how well it can be. It's sort of personalized Bitmojis and...
Is that what they're touting?
I don't know.
Okay. Apple's down by about 1/10 of 1%. That's not getting me to upgrade. Let's put it that way. Big week of central bank decisions coming right up with the Fed very much in focus. The FOMC widely expected to keep rates on hold this Wednesday, but set the stage for a September rate cut. Joining us now to discuss is James Camp of Eagle Asset Management alongside Zach Griffiths of Credit Sites. Gents, great to catch up with you both. Zach, I want to come to you first, sir. Give us a read on what you're expecting this Wednesday and how it might set us up for what could happen in September.
Yeah, John, we are looking for the Fed to make adjustments to its policy statement to indicate more of a concern in terms of the labor market, or at least dial back their assessment of strength in the labor market and continue to emphasize progress. On the inflation front, we expect Chairman Powell to indicate a willingness to cut in September. We don't think he'll be very explicit in saying that they will cut, but keep options open, keep that data-dependent mantra. We think the data supports a cut in September.
James, of course, we're all much more interested in the 100 basis points after that, if there is a 100 basis points after that. What is the destination you think this Fed is heading towards, and what kind of economic regime do you think we're in that guides that?
Well, good morning. Good to be with you. We're in a reflation regime, right? The anchoring that we had in the post-financial crisis period up to COVID is gone, and we have a new economy. And that new economy has more stubborn inflation. You know, we've written about onshore, we've written about pricing power, we've written about a tighter labor market. I think the Fed does cut in September. This is the clearest data that they're going to have to give them that opportunity. But the base effects and some of the inflation inertia is going to come back in the fourth quarter. So I don't consider this a Fed pivot. I consider this a Fed sort of getting back to sort of more normal on the funds rate. But I wouldn't extrapolate this September meeting, which is likely to be a cut, maybe even 50 basis points, into a protracted policy adjustment over the next couple of quarters. This is a late 2025 kind of phenomena where we'll see what the terminal rate will actually be. But that number's not imminent.
Hold on a second, James. Did you just say that there's a real possibility that the Fed will cut by 50 basis points in September?
Yeah, I do think that's the case, Lisa, because I think that this is going to be the clearest data that they'll have to give them the inflation cover. And I think they've wanted to move the last couple of hikes off the table. So I think this is the window. This is a kind of a little bit of spitballing with the inflation data. But we know if we look at the data series, it's not going to get easier to make the inflation case in the back half of 2024.
Okay, so this is basically they have an opening. So let's go full. I mean, Zach, what do you make of that? Do you think that that's a feasible possibility that the Fed's going to cut by a 0.5 percentage point?
That's not our base case, Lisa, and I think that would perhaps spook the market a little bit in terms of that big of an adjustment when just a couple weeks ago policymakers were saying they need to see a lot more data in terms of being confident we're sustainably moving back to 2%. So I'd almost think of that as having the same impact as cutting this week, showing the market perhaps there's more to be concerned about. So that's not our base case. We do think the Fed is going to be easing at a steady clip once they go in September, really trying to bring that policy rate back towards something that looks at least a little bit more like neutral. We think we're coming from a pretty restrictive rate now, which is not what the economy needs. We're seeing signs of slowing, especially in the consumer. We expect that to be a bigger market driver in the second half of this year and into 2025.
Zach, just to be super clear, are you making a growth call here, not an inflation call?
Well, that was a call on growth coming down. We think moving back toward below potential is what you're going to see over the next 12 months. We've had extremely strong growth and still had inflation come down quite a bit. So we think with inflation where it is, the Fed's starting to ease. We're already seeing signs that the economy is cooling. We think that continues and starts to have a bigger impact from a fundamental perspective on where credit spreads go from here, which is why we're in a bit more of a defensive camp than we have been for much of the past 2 years.
You've set us up with the market conversation. Let's go there. Let's stay on it. Zach, if you're looking for wider spreads potentially, where's the 10-year? What kind of level of credit spreads are you looking for into the growth slowdown that you're expecting is going to trigger quite an easing from this Federal Reserve?
So we're looking for the 10-year to go back to 3.25 at the end of the first half of 2025, John. So that's a pretty big move lower from where we are today. And we have investment grade credit spreads going to 120 basis points, high yield to 400 basis points. So not a terribly huge move in terms of spread widening, as we think the technicals, the cash on the sideline, and plenty of cash that we think wants to be put to work in other asset classes provides an offset to more of this fundamental concern we're expecting to be driven by a more notable economic slowdown than what's currently priced into consensus expectations at this point.
This is great because both of you kind of highlight the two sides of the debate right now. And that I think is a wonderful thing to have. James, it seems like you're more constructive. You think that the Fed is going to cut for the right reasons. They have an opening to do so to prolong the economic cycle. Zach, you seem a little bit less constructive. James, what makes you think that this is going to be a good kind of rate cut in the sense that it's just simply to adjust policy mid-cycle to allow growth to continue?
I think there's two financial conditions we have to look at. For large cap, big companies, financial conditions are extremely loose. For down market consumer, this is the bottom 80% of our income strata. Credit card debt is high. Credit card payments are high. And the Federal Reserve policy has directly impacted those down market consumers. The credit conditions in the capital markets are still loose. Equities at all-time highs. The VIX low. Credit spreads, as your other guest just mentioned, very, very tight. We have a very bifurcated economy, and I think the Federal Reserve has to be mindful of the fact that housing affordability is at 40-year lows, that the down market consumer is under significant strain. We saw that with some consumer discretionary earnings this morning. So I think this is more an opportunity and a window to kind of get right or closer to where the policy should be. But I will tell you that the inflation data is not going to be constructive in the back half, and they're not going to have this sort of wide open field to begin a real significant easing cycle for the next couple of quarters.
Well, James, though, do you agree with Zach that that means probably wider credit spreads than you could end up seeing, maybe a little bit, and I'm just extrapolating here, putting words in Zach's mouth, he can correct me, but basically potentially a reversal of the small caps and a sort of reversal of just sort of this belief in a cyclical trend. Do you think that we're going to see that kind of response, or do you think that people are going to welcome some sort of adjustment by the Fed as allowing that to sort of right-size itself, to allowing the cycle to continue?
I think it's the latter. I don't think corporate spreads are bound much wider from here. There's a lot of demand. We know that at peak Fed, which we certainly can both agree, I think we're at peak Fed, that corporate credit, that municipal credit, that bonds outperform every time. Go back to 1989, you have 5 Fed tightening cycles. And at peak Fed, you have great returns to fixed income, and you have great returns to dividend growers. And as you mentioned, that rotation that began July 11th, with the more benign inflation data into small cap out of mega tech, that has also buoyed the dividend trade. So what we have now is a very generous income market for investors, and we also have a market that will be underproductive for cash. Cash yields today will not be cash returns over the next 12 months. So clients and investors that have money to invest, the income space looks extremely generous, both on the dividend and on the debt side.
Zach, I want to give you the final word. You can use your own words. What's your response?
Well, I think the huge differentiator here is, are you a total return or excess return focused investor? We think the next 12 months look very solid from a total return perspective. If you're focused on that excess return and that credit spread component, it's a little more difficult. And so overall, we do think it is a positive environment for fixed income, but starting to see that spread widening. If you're a credit and excess return focused investor, you need to keep an eye out for that.
Gents, this was great. Zach Griffiths of Credit Size, James Camp of Eagle Asset Management. Thank you very much. Looking ahead to a massive week with the Federal Reserve and all that data coming right up.
You know what we didn't even get to? The quarterly refunding announcement. And you know who's going to talk about that? Zach Griffiths. So we'll have to have him back sometime, because he was saying it's actually, really significant. He said that that actually could be, market moving.
Okay, is Zach still there? Can we find out? Is he still there? Or have we let him go? They're going to find out for you. All right, we can do this in real time. We change the whole show.
All right, we can let it go.
He's good. He's here right now.
He is?
Yeah, I've got him back in. Go for it. You want to bring him in?
Yeah. Zach, just quickly before we let you go, and we brought you back on just for this, how important is the quarterly refunding announcement?
We think it's important, but we're not expecting any major changes this week. I'd be focused on what happens this afternoon with the quarterly borrowing estimates. I think that's more likely to surprise the market than what we hear on Wednesday morning, but that's going to be huge. There's a lot of focus on it now. It's something I've focused on for many years. I'm surprised to see how much it's in the market. Overall, no change. We're not expecting that to outweigh the shift in monetary policy and the economic landscape, which pulls yields lower.
Well, that was anticlimactic. Thanks for jumping back, Zach. Appreciate it. Thank you. Zach Griffiths there at Credit Size. I'm going to go now, okay? Let's get you an update on stories elsewhere. With your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. A check on McDonald's shares in the pre-market up more than 1%. Sales declined for the first time since 2020 from international to U.S. locations. Each of McDonald's geographic footprints saw sales declines for an overall drop of 1%. The estimate was for a 0.8% growth. The company's CEO said consumers were being more discriminating with their spend. McDonald's and its competitors are now offering discounts to lure back customers. McDonald's latest is a $5 meal deal that it launched last month. And another attack has occurred on France's infrastructure during the Olympic Games. This time, a number of fiber optic cables were cut overnight. The cables carry broadband services across France's southern and eastern regions. Orange, the Olympic telecom partner, said the connections into Paris, and thus the Olympics, were not affected. Just on Friday, coordinated fires on French rail lines had disrupted trains ahead of the opening ceremony. And Disney's Deadpool and Wolverine shattered box office records this weekend. It brought in $205 million. The superhero buddy film scored the best ever opening for an R-rated film, with more than twice the ticket sales of 2019's Joker during its first weekend. The latest entry in the ever-expanding Marvel Cinematic Universe continues Disney's hot streak this summer after Pixar's Inside Out 2 grossed almost $1.5 billion since its June release. And that's your brief, John.
Danny, thank you. Thanks for this morning. Up next on the program, we'll set you up for a big week ahead from New York. You're watching Bloomberg TV.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
The opening bell for the first trading day of the week, about 40 minutes away. Equity futures going into that positive by 0.5% on the S&P 500. It's a long, long week. A busy one, that's for sure. In the bond market, yields are lower by 3 or 4 basis points on a 10-year, 415.69. In foreign exchange, the dollar showing a bit of strength against the weaker euro, 108.16. We're negative on that currency pair by 0.4%. A lot of focus will be on dollar-yen. Dollar-yen having 4 consecutive weeks of yen strength for the first time this year. Coming into Monday, we're down to about 153. Positive this morning by a 1/10 of 1%, 153.88 on dollar-yen. The trading week looks like this. This is the lineup. Tuesday, JOLTS and consumer confidence data. Wednesday, ADP plus a decision from both the BOJ and the Federal Reserve, followed by a Chairman Powell news conference at 2:30 Eastern Time. Thursday, we'll get another round of jobless claims plus a Bank of England rate decision. Friday, US payrolls report, tons of earnings in between, results coming from Microsoft, Meta, Apple, and Amazon. And just for Lisa, drum roll, the quarterly Treasury refunding also coming up on Wednesday. Mike McKee drops by to give us his thoughts on the data for the week ahead. Mike McKee, good morning, sir.
Good morning.
All that data, just where is this economy right now going into this Fed decision on Wednesday?
Well, I'll talk to you on Friday when I see all this data.
Come on, work with us.
The economy is in pretty good shape. It's slowed down. It hasn't crashed. Inflation is coming down according to all the latest data. And Fed officials who've been talking to CEOs say that people are still relatively optimistic. So we're probably set up for the Fed to hint at a rate decrease ahead. I was kind of thinking last night, it's a bit like one of those gender reveal parties where maybe we give Jay Powell a piñata and he hits it, and instead of boy or girl comes out as September or November, and we see which one they're actually going to do.
Is that an actual recommendation for the Federal Reserve? You're going to give that to Chairman Powell
The
on
ratings
Wednesday?
would go up. A lot more people would watch you.
I imagine they would. Thanks for that, Mike. We've got to do gender reveals. Every payroll's Friday, every Federal Reserve.
I mean, between the Bachelorette that's going on with the Vice President's Day, and you've got, you know, gender reveal for the Federal Reserve, what kind of country are we coming to?
If you were going to schedule this for ratings, though, I'd have payrolls on a Wednesday and the Fed decision on Friday.
Exactly.
Wouldn't you?
But that's a problem for the Fed because they don't know what's going to happen. And if we do get a 0.1% rise in unemployment to 4.2%, that should trigger the Somm rule. And while the Fed isn't particularly worried about it, it'll obviously worry the markets, and it'll be, Are they now going to be able to cut? We'll have the Fed say whatever they say, markets will adjust on Wednesday, and then Friday it may be a whole new story.
Okay, just going with the gender reveal party, that's not going to happen anyway until Jackson Hole, right? I mean, we're not going to actually get anything from them. I mean, we've been basically setting up that Wednesday is going to basically be them saying we're data dependent, any data point could be live and could really tip us over the edge. Is that not what we're going to hear from them?
I think they pretty much have to give some sentiment about September because the market's all focused on it. If you're waiting till, why do you wait till Jackson Hole? You don't really need to. If they think that rates should go down now, you can say you're going to cut rates in September or hint strongly at it, and then rates are going to go down because people are going to start pricing it in. So you get the effects of a rate cut. And you've got a lot of people like Mohammed El-Arian, Alan Blinder today saying the Fed needs a cut right now.
They should ask Christine Lagarde what it is to pre-commit to a cut and see whether or not they actually want to do that. Well,
that's why they'll dance around.
Right.
They won't say September.
Correct. Maybe we could ask Christine Lagarde. There is this issue, though, of some of the sleeper data points that we get. JOLTS data, we also get ISM manufacturing. What are you watching in terms of some of those sort of tertiary indicators that could be as telling or market moving as some of these other bigger data points?
Well, we're watching ECI, which is on Wednesday as well, because the Fed follows that in terms of pay and compensation and whether that's putting upward pressure on inflation. And it's been coming down, so we'll see if that continues to happen. Obviously, ISM manufacturing, we'll look at the sub-indexes there about new orders, see what it looks like going forward, and prices paid. And jobless claims. Everybody wants to know what's happening with the labor market, so that'll be interesting to see. But obviously, jobs Friday, the big day, the big data of the week.
Just short of 180 is the estimate, the median estimate in our survey. I think it's 178, Mike?
175 or 178,
175?
yeah, it's been bouncing around.
The 170s, as that changes as we get more estimates and they come through into our survey. Mike, great start to the week. Appreciate it, sir. Mike McKee there on the latest. Massive week ahead.
Yeah, that might end up with a gender reveal that says December or September, and it will be September. You know, honestly, it is a massive week, and I think we've really broken it down to the idea of economy. We've got decisions from central banks, and we have earnings. Everyone's been saying earnings so front and center, given how much of the index is going to be reporting this week.
Light on politics. How relieved are you? Very.
Anne-Marie's not even here. She's like, peace
You're
out.
going to get a vice presidential nomination.
Yeah, exactly.
Even Anne-Marie's taken a week off.
Yeah, exactly.
Like that tells you everything you need to know about politics.
It'll insert itself somehow.
I have no doubt it will. Coming up tomorrow, here's the lineup. Bob Dole of Crossmark, Mona Mahajan of Edward Jones, Matt Hornbeck of Morgan Stanley, Tiffany Wilding of PIMCO. Have a wonderful week, a busy week ahead of us all. Thank you very much for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Look at the number who learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, into dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
Futures higher to kick off a busy week in earnings and central bank meetings. 30 minutes until the start of the cash trade. I'm Matt Miller.
I'm Shonali Bassett.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, a trio of central bank meetings this week. We'll get decisions from the BOJ, the Fed, and the Bank of England.
We also get earnings from a quartet of Mag 7 stocks worth nearly $10 trillion combined. Microsoft, Meta, Apple, and Amazon results all on deck this week.
But first, we'll dig into McDonald's as the change sales fall for the first time since 2020. Let's take a check on these markets. About 30 minutes until the bell rings. You can see we have a lift to futures right now ahead of that very heavy week. The S&P 500 up about 0.4%. You have big tech leading the way. NASDAQ 100 up about 0.7% with some big earnings on tap. And the bond market, that rally just continuing. The 10-year yield currently down about 4 basis points. We're camped out at about 4.15%, Matt.
All right, take a look at real rates right now. Even though you think they may not have come down everywhere, certainly not at the Fed, as we get inflation cooling, real rates begin to rise for the central bank here, for the Bank of England, for the Bank of Japan. Here you see where we are, and that could indicate more willingness to cut over the next set of meetings.
That is going to underpin the market, but let's look at the stocks underpinning the market right now. McDonald's sales fell for the first time since 2020, yet the stock is on a rise pre-market about 0.7% higher. McDonald's did keep its forward guide stable. Tesla also on the rise as Morgan Stanley names the top pick in U.S. autos here, up now 1.6%, Matt.
All right, that's an interesting call by Adam Jonas. Love to talk to him about that one. But we've got a lot going on outside of autos, right? Last week we were very focused on Ford, Stellantis, and General Motors. This week we've got all of the mega cap, or 4 at least, of the mega cap tech companies reporting.
Yeah, absolutely.
As well as some mega cap central banks.
We have some mega cap central banks, and I know there's a lot of focus on tech, and there should be, but we also have big oil reporting this week. Of course, we have McDonald's, Starbucks, Wendy's, so a really nice snapshot of really Wendy's. The entire economy.
All capped up by payrolls on Friday, so busy until the very end.
Yeah, let's talk about that right now. We want to bring in Kate Moore because it's, as we said, a big week for markets, a big week for earnings, a big week for central bank decisions. Actually, first we're going to go to Michael McKee here. He's standing by, Bloomberg's chief international economics and policy correspondent. Mike, I forget about you because you're over there in the horseshoe.
I'm the warm-up act here. You know, I got to get the audience warmed up for Kate. We'll do that. Because we do have a lot going on this week, and we start with the central banks, as you were talking about. We have the Bank of Japan and the Federal Reserve reporting on Wednesday, the Bank of Japan early in the morning, our time, and then the Bank of England on Thursday. And we're not expecting real moves from the Bank of Japan or the Bank of or the Federal Reserve, but we might get something from the Bank of England. Now, if you look at what the OIS forecasts are for the 3 banks, you can see that it is a question mark about September. That's not our chart, but it's a question mark about September, but...
that's mine, Mike.
That's yours, yeah. A question mark about July. But in September, all three banks are expected to be moving, and the difference, of course, that's the chart, is the blue line is the Bank of Japan. They're going to be going the opposite direction. They've got inflation, and now they're thinking it might be a problem after all these many years. So keep an eye on the Bank of Japan going the opposite direction. And if that happens, of course, you're going to keep an eye on the yen, which has strengthened in recent weeks on predictions that we will see that divergence. The Fed start cutting way over on the left-hand side. You can't even see what the odds are of the Fed moving on Wednesday, but it's going to be very, very low. And then, of course, you were mentioning jobs on Friday, but we got a lot of data before that. We've got the JOLTS report coming tomorrow. That always moves markets. Consumer confidence. ADP gets traded on, whether it makes sense or not. And ECI, the Fed wants to know what's happening with wage pressures. Thursday, ISM manufacturing jobless claims, are those coming back down again? And I don't even have to promote Friday. I know you guys will be beating the drum for that all week. Jobs Day. Everybody has to stay in town this week for all this data.
Yeah, some top-tier data coming out at the very end of the week. So we have the Fed. We're keeping an eye on the BOJ as well. And the Bank of England, we should mention, that really feels like a live meeting, Mike McKee.
It is a live meeting, and it's just about 99% that they do cut rates, but the bank has been pretty divided over this for a while, so it is possible they hold off. We're just going to have to wait and see where they see the balance of risks at this point.
All right, Mike, thanks very much. Michael McKee there in the horseshoe giving us the lowdown. Right now, let's get to Kate Moore. She is head of thematic strategy for BlackRock's global allocation investment team. And I guess we could start on central banks, since we just heard from Mike. We had a blowout GDP number last week, and nonetheless, most people are still calling for rate cuts. Do you expect September to be it?
Yeah, we're in the September camp for sure, and we think there's a great likelihood actually that we could get 3 cuts in 2024, and then 1 in the first part of 2025, and then kind of a pause that refreshes. We'll take a look at kind of the impact of the 100 basis points of cuts and see what that does for the economy. I think your point, though, around the GDP number is important, because we've had a lot of cross currents in the economic data. There has been, some indication that the economy and the consumer are in good shape, and then you get anecdotes from companies and sometimes from the labor market that suggest there's some cooling. So I think being a Federal Reserve decision maker right now is an incredibly difficult job, and they want to be cautious, especially going into the election.
Kate, why 3? That brings you above consensus. What would cause the Federal Reserve to have to cut rates 3 times? Is that a sign of weakness or strength?
Well, it depends on how you cut it. I would say we're not as stressed out about the labor market softening too much, and that being the reason for the Fed to continue to ease in 2024. It's more about our expectation that we're going to have more disinflationary pressure over the course of the end of the third quarter into the fourth quarter. So I'd say that's a positive sign. And against that backdrop, we think consumption is going to be pretty good. So even if we're calling for kind of 2 to 3 this year, we're in the camp of a pretty good economy and nothing that looks like a recession in the very near term.
So how do you put that into a portfolio? Because a lot of people have been looking at some of those factors that you named, the fact that maybe things are softening up, but the economy is still strong. We're going to see the Fed finally start its rate cutting cycle, and that screens bullish for small caps. At least that's what we've heard on this program. How are you feeling about the state of the rotation right now and the durability of that?
Yeah, so the small cap story is really complicated. A lot of people get themselves very excited about the fact that, lower rates are good for small companies. And that may be true, but it's not the first or the second or perhaps even the third rate cut that really trickles through to the bottom line and to their interest expense. And if we're cutting rates because the economy is softening, instead of like a stable economy with just prices coming down, that's a different story for small companies. I'm a little bit less constructive on the fundamentals, and I would know what's happened during the course of earnings season when analysts have been revising down their small cap earnings expectations as companies reported, which is a different trend from the large space. I understand the rotation. I understand people wanted to even out positioning, but I don't think there's a huge fundamental driver for the small company space at this point.
So that's the size story. What about the sector story too? Because you've also seen it within the large cap space as well. Those underloved sectors, financials, healthcare, energy, et cetera, also catching a bid there. Does that make more sense?
I think we're at the end of the technical part of this rotation, and a lot's going to be dependent on what happens in earnings, not just this week, but next week, which is also a huge week in terms of reporting. Look, I think it's critical to see what happens to tech earnings. If we end up getting solid tech earnings, and the guidance is not just stable from where companies had guided, in the first quarter, but actually perhaps raising and talking about areas of potential revenue growth, I think that will get confidence back in. But right now, people are worried that there's been too much price performance and not enough action. And this is kind of a show-me earnings season, in my view.
I'm wondering what to make of those big tech names. A lot of people are asking, where does the rotation come from?
Yeah.
Does it come from your cash holdings, or does it come from taking profits out of those high flyers and pushing them into other names?
I think it comes from taking money out of these high flyers. We're actually saying, after a phenomenal first half of this year, taking a little bit of profits, thinking about balancing out your risk, and just understanding that in a second half of the year where, earnings are going to be very important, central banks are going to be moving, and there are critical elections and geopolitical risks, you just want to come in at a more neutral stance than most people were, let's say, in May.
What about regions? I noticed that you like Japanese equities, and I feel like that's a new thread that we're starting to see in terms of performance.
Yeah, outside of the U.S., Japan is our largest country overweight. We've had that position on for a number of months at this point. And we're kind of playing this both through single names as well as through index exposure. Look, we think there's some positive momentum in Japan. In the last 25 years plus of my career, there have been a lot of times where people gotten excited about Japan and it just never followed through. But we're getting that little bit of inflation, we're getting that little bit of growth, and we're seeing more optimism on the part of the Japanese companies. Plus, there's some good fundamental stories in there as well around industrial automation, and supply chain shifts, and the proximity.
Those are the things they do well.
There's some things that they do really well, exactly.
What about the yen? I know I've been looking at Japanese products a lot more lately. Obviously, 150 yen to the dollar makes it a lot cheaper. Is that a real tailwind, you think?
I think it can be, but we also need to be conscious that there may be some intervention at some point. I'm not an expert on the currency side, but we are really thinking about how we want to hedge or not hedge our currency, given the fact that we are at 150.
So let's stay international too, and let's talk about Europe, because it seems like you're overweight to consensus on Japan. Not the case when it comes to European side, though.
Yeah, no, I think in Europe you need to be a stock picker. There's so much in the index, frankly, that doesn't look great. Or the great companies trade at this massive premium valuation to everything else, like 30% to the rest of the market. And on that front, you just have to ask yourself, is this the point in the cycle when you want to buy the massive premium? I also don't love how little tech exposure and how little kind of innovation there are represented in European indices. So we need to be really conscious of that. That is still our core belief that technology and spending on technology are going to really drive the market higher, even if we have some more indigestion in the near term. Although I must say, I'm quite cautiously optimistic about earnings this week for those big four.
All right, we're going to talk more about that with you. Stay with us. Kate Moore from BlackRock is going to hold over. Another quick check on futures, though, this morning. After a drop in the equity indexes, at least the S&P, last week, it was down almost 1% last week, the second drop in a row. We see gains to kick off this week, up only about 1/3% on futures, but NASDAQ futures are up higher as we await these big tech earnings. Not sure about the rotation today, but there's the Russell up 0.3%.
Still higher.
It is still higher. That's true. We'll talk more about those big, giant, mega cap companies next. This is Bloomberg.
The names that move markets are on Bloomberg.
With all due respect and thoughts and empathy and sympathy for the people who are suffering at the moment, and there are plenty. It's not just Ukraine and Gaza, it's in many other corners of the world as well. But I'm constantly surprised by the level of resilience and the capacity to actually bounce back from those traumas. So I have faith in the human beings and their capacity to respond to adversity. We've seen it. You know, look, earlier in the pandemics, we thought that the world was coming to an end, right? It hasn't. Nobody thought that vaccines would come up in such a short period of time. And every time we have to constantly resurrect this spirit of resilience.
But are you hopeful that...
I'm always hopeful. Oh, come on, we have to be. We have to be.
Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg. The Fed decides.
Who said summers were quiet? I don't remember the last quiet summer.
We're talking about the data not being as accurate during this time of year, an election that's haywire.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Is the answer here, Jeff, that everything is just plain solid?
It's pretty solid, Tom.
At some point, we got to call it a soft landing.
Tune in to Bloomberg Surveillance. The Fed decides, starting at 1:30 p.m. Eastern.
Let's get now to high interest to look at what's making headlines around the world. President Joe Biden will call for lawmakers to pass new binding ethics rules and term limits for Supreme Court justices today. The move comes as the latest part in a sweeping proposal that would fundamentally alter the United States top court. And the sabotage story continues in France. During the Paris Olympics, a number of fiber optic cables carrying broadband services across the country's southern and eastern regions were cut overnight following a massive attack last Friday on the country's super-fast rail infrastructure. Connections serving the capital, however, where the Olympics are being held, weren't affected by the latest disruption. And political tensions are ratcheting up in Venezuela after President Maduro was declared the winner of Sunday's election. An exit poll conducted by U.S. firm Edison Research found that Maduro's opponent, Edmundo Gonzalez, had won by more than 30 percentage points. The opposition called on the military to enforce what it called the will of the people.
And there's a big week ahead for tech heavyweights. We're going to get results from Microsoft, Meta, Apple, and Amazon. Kate Moore of BlackRock, she's still with us. She has an overweight position in tech and AI. And just before we went to break, you talked about a cautious optimism about this earnings week.
Yeah.
What happens if they miss?
I'm not worried so much about the miss. I think the real focus here is on the guidance, because that's what, most people have been worried about, is not whether or not we had a strong second quarter, but do companies feel confident about third, fourth, and the beginning of 2025? It's going to be a real show-me moment from the guidance perspective. I think people are anxious given the price performance in the tech sector and the AI and AI-adjacent names over recent weeks, and have kind of said, is this the end of the trade? We think we're at the very beginning, frankly, of the spend in this space. People who are frustrated and uncomfortable with the fact that there's been an enormous amount of spend, but we still have an enormous amount more to go in order to really embed this technology in all of our different businesses, need to just kind of take a breather.
Hang on, don't you put any hedges against a miss? I mean, we've seen huge punishments for light misses so far in this earnings season.
Yes, in fact, we've been adding to our hedges over the course of the last couple weeks. That said, we haven't been drastically slashing to underweight all of these other single stock positions. We've been cutting tech a little bit since the peak we had in the mid-late spring from a risk management and portfolio construction perspective, but we still feel convicted that this is going to be the most powerful theme over the next couple years.
So I want to go back to the show me story, because we were speaking to Larry Adam from Raymond James last week. He made the really interesting point that you want to be where companies are spending money, not necessarily the consumer. And obviously companies are spending money on tech, on AI. But to your point that this is a show me story, it feels like the market is really coming to grips with the fact that that ROI is going to be much further off than maybe first expected when it came to AI. I'm wondering how you're thinking through those different components there.
Yeah, that's exactly right. There's this anxiety on on the return on investment right now. And I think it feels a little bit misplaced to me, to be very honest with you. I mean, we are, just a few months ago, we're talking about how we were at the early innings, to use the baseball analogy, early innings of the spend. And then 3 and 4 months later, people are like, why isn't this working yet? There has to be a little bit of patience, especially with these big structural shifts. This is technology that's going to disrupt every industry, hopefully improve efficiency and productivity. And companies need to spend and build before we can actually see those use cases, and deliver to the bottom line. So I'm not giving up yet.
Not yet. Kate, what about outside of the big tech names and into the semiconductors, into the chip makers? You look at Intel reporting earnings this week, has taken a real hit this year. On Semiconductor reported this morning, just soaring pre-market. Where do we stand in that part of the sector?
Well, I think this is a great example. There are winners and losers within the semi space, right? And if you are in the right space and you're seeing demand continue to accelerate, you're great. If you are kind of in an older business and you're not innovating and keeping up with where demand is going, you're really going to get punished. I think we're going to see more of that this week too with all of these earnings, is that, if you meet numbers and raise guidance and show a level of confidence, the market's going to reward you. And if you don't, you're going to get really punished.
There are winners and losers in every space, but do you go to data centers around AI? Do you go to power generators, utilities around AI? Are there certain segments of this business that you think you want to get in early?
Yeah, everyone was rotating into the utilities and into the, power suppliers for data centers, but that's a little further off. We're still in the buying chips and building kind of phase. So that's kind of my favorite place within the AI theme. But I was thinking about this as well, as we're talking about these winners and losers and big, market reactions to earnings. It is a great environment for active managers and for people who are trying to generate alpha, but you have to be on your toes. It's not a set it and forget it kind of market.
I do want to go back to that point, though, about where we are in the AI investment cycle, because that's something we think about and talk about a lot. So still buying chips, sort of the picks and shovels of AI. Too early to invest in some of maybe the data centers, power providers. If that's the case, I have to imagine it's too soon, too, to pick winners when it comes to the actual applications of AI as well.
Yeah, I think that's right. But what people are listening for as companies outside of the tech ecosystem report is, do these companies think about their AI and technology strategy? Are they saying, this is how we think we'll be able to use this technology, this is how we're setting up our infrastructure to try? If you don't have a strategy and you just say, hey, I think that's something of the future, then everyone is rightly concerned. They're going to get left behind. Within each industry, whether it's consumer or industrial, energy, any sector industry, if you don't have an AI strategy and a technology strategy, it's a reason for concern.
Kate, you mentioned a little earlier you've been increasing your hedges of late. How do you hedge this market?
So we use a lot of options, and I've been doing stuff on single names as well as on the index level. We are very active in our fund relative to, say, a more traditional mutual fund in hedging and being very tactical around volatility and big events. I've done some stuff across the semis and technology space more recently. Again, not selling my core positions, but just trying to do some prudent risk management and looking for opportunities when vol gives us that entry.
And I mean, just really quickly before we let you go, the sort of the fact that you hedge single names, you hedge the benchmark, are you sort of switching that dynamic? I mean, what does your single stock hedging look like right now relative to just looking at the benchmarks?
Yeah, look, it depends on what individual positions are. If we have an opportunity to kind of overwrite something, if we have an opportunity to kind of sell puts on something we want to continue to hold, but take in a little bit of premium, these are kind of strategies we might use. Or if we think things are going to be in a tight trading range, we'll use that as an opportunity as well.
Kate, it is great to see you. Really appreciate you stopping by to help kick off the week. That, of course, is Kate Moore of BlackRock. And coming up, we'll take a look at the companies making the most social buzz today in our Social Climber segment. Up next, this is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on where markets are headed. Just about 6 minutes away from the opening bell. You can see S&P futures are up to kick off the week, just about 0.25%. NASDAQ 100 futures up a little bit more than 0.5% right now as we await the big tech earnings. Russell small caps gaining as well, just 0.2%. But definitely better than last week, which was down, Katie, I think about 0.8% in total.
All right, there you go. It's time now for Social Climbers, the company's making waves on social media this morning. And first up, ARM Holdings under pressure on some analyst action. HSBC downgrading shares to reduce, pointing to fresh cracks in the AI narrative. Next up, take a look at shares of Alibaba, moving higher in the pre-market after announcing plans to raise service fees for its clients. And finally, McDonald's kicking off a busy week of U.S. earnings, results falling short of analyst estimates, posting its first quarterly decline in global sales since 2020. And this is an interesting one, guys, because they did introduce that $5 meal special, but not until so late in the quarter that it's not quite showing up yet.
Yeah, it was only the last week that you could get that. And part of the problem is the price of, the traditional Big Macs have risen. Although they've introduced some new products here, Shonali, I'm looking at the Bacon Cajun Ranch McCrispy.
But how much does that cost?
It's whatever it is, it's too much for me.
You know what's interesting? After market tomorrow, Starbucks reports, and a big question about how much people are trading down. Now, will Starbucks give you a cheaper option is what I wonder. And Wendy's got to stay premium.
You got to find a Starbucks first. Or a Wendy's. Neither one is around here.
That's true. But Wendy's does also report this week. And I have to say, I'm more of a Wendy's gal. So we'll see.
More on earnings next. We're going to speak to one of the biggest bulls on Wall Street. Stick with us. This is Bloomberg.
The linear business is not going anywhere. The sports business is moving is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be. Every single one of the players want to be in it because of the audience. We have two assets in the sports business that are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
We are moments away from the start of trading. After back-to-back weekly losses, we kick off this week with futures higher. I'm Matt Miller. This is Bloomberg Open Interest. Just about 16 seconds to go. You can see S&P futures up. It's fairly tepid, only 0.3%. We're awaiting all of the big mega-cap tech stocks reporting this week. I shouldn't say all. 4 of the big mega-cap tech stocks this week. So that's what we're focused on, along with the Fed, the BOE, and other central bank decisions. You heard the opening bell. You see Kane Anderson on the New York Stock Exchange. Over on the NASDAQ, we see Alaris celebrating their 5th anniversary of a listing. Let's get over to Katie Greifeld. She's got a look at the early trade. Katie?
So far, a few minutes into the trading day, you can see currently there's green on the screen, tepid as Matt called it, but the S&P 500 up about 0.3%. Big tech leading the way so far. NASDAQ 100 up about 0.5%. Your small caps, not exactly a rotation, but a broadening out today because the Russell 2000 currently up about 0.3%. But one stock to keep an eye on at the opening bell, that's on Semi. Shares really advancing right now after the semiconductor device company reported second quarter adjusted earnings per share that came in ahead of estimates. Shares currently up about 9.4%, Shanali.
Katie, I'm keeping an eye on crypto-related stocks. Coinbase, Riot, Marathon Digital, all rallying. Republican nominee Donald Trump over the weekend, you may remember, expanded his supportive rhetoric of cryptocurrencies, shifting away from being skeptical of the digital assets. Coinbase up nearly 3%. Riot up more than 5%. Marathon Digital, also buying more Bitcoin, by the way, up almost 5%.
Getting ready for a big Bitcoin buildup. Also, McDonald's sales fell for the first time since 2020 on a quarterly basis on lower than expected growth. That's clear because sales fell. Let's get a closer look at McDonald's stock right now with Bloomberg's Abigail Doolittle. Abby?
Yeah, Matt, it was a miss right across the board, basically, for McDonald's. Right now, the stock down slightly. Earlier in the pre-market, it had actually been up about 0.5% to 0.6%, perhaps on the idea of less bad. But we since then have had, and now flipping slightly higher, commentary for the company on the call. Not so great. They are saying that the backdrop right now is more difficult than expected last year. Demand is falling among low-income consumers. They also are seeing a negative third quarter comp across all segments. So not so great, but one reason that we may not have this stock plunging, or even it was higher earlier, if we put McDonald's into the context of the other indexes on the year, what we're looking at here in white is the S&P 500 up about 15%. The restaurant index down about 10%, and there's McDonald's down closer to 15%. So we have some real underperformance here from McDonald's on a stock price. Shanali, I would say that a lot of this weakness is priced in. However, if this weak commentary continues, keep an eye on McDonald's. It could really be a tell on rising prices, stretched budgets for Americans and, frankly, people around the world. This could be a good tell on the state of the consumer.
Abby, thank you so very much. Of course, that is Bloomberg's Abigail Doolittle. And joining us now, John Stoltzfus, Oppenheimer Asset Management Chief Investment Strategist, one of the biggest bulls on the street. And you take a look at McDonald's this morning, for example, Starbucks tomorrow, then Wendy's, and of course, a horde of big tech earnings. Where are the weaknesses of this earnings season? Are there places that even you are now shying away from?
Well, we'd have to say that where the weaknesses are, it's pretty pronounced. If you look at the EA page, you've got energy so far. Earnings growth is down negative 14.23%. Real estate, negative 14.63%. And materials, single digit down, but at negative 6.05. Of course, we're still early in this midway through the earnings season. So we'll have to see what happens. But overall, you've got 4 sectors last I looked that have double-digit earnings growth, and it's a combination of things like tech, cyclicals, and I think at least one defensive sector, as I recall. So all in all, much like we would expect, this is transitional into a new normal.
And John, it feels like a real make or break week when it comes to the rotation trade, the broadening out trade, whatever you want to call it, because of course, it's been a while since we've seen big tech report, obviously, and it feels like every quarter, a lot of these companies come out and sort of shock the markets with these big numbers, and then suddenly tech is back in charge and leading the market. This time around, are you expecting a similar dynamic?
I think, to see mixed results come in from an area that's been particularly hot is not surprising as we go forward. We've seen it in areas with financials and the process of the recovery. And we've certainly seen it, of course, in technology. Traders tend to throw down anything like a hot potato on disappointment. But the reality is it creates opportunities for people to really dollar cost average, gain exposure, stuff that may have been a little bit too expensive before. This looks to us like a relatively healthy rotation, rebalancing, with likely tech to remain in the leadership, though giving back some of those gains on profit taking by bears, nervous investors, and investors who just want to take a little cash off the table, maybe build a shopping list to look for any babies that get thrown out with the bathwater on day-to-day trading.
So, John, we've been kind of waiting for a rotation in earnings as well. Our own Gina Martin Adams at Bloomberg Intelligence has said that, we're going to see not as much spectacular growth from the Mag 7, whereas the S&P 493, as she calls the rest of the market, had been in an earnings recession and we're starting to expect growth from them. What's your earnings outlook, going through the rest of the year for these other companies?
Yeah, we think we're going to see improvement there. One of the best interviews I've seen lately on Bloomberg was David Rubenstein's interview on July 25th of Fed Chair Jerome Powell. And Jerome Powell very clearly gave credence to the thought that, things are really are improving both on the inflation front, as the Fed brings inflation down now, 11 hikes and 8 pauses thus far. And at this point, really, they're looking at the jobs market, and that remains remarkably resilient. We won't say robust, but if you look at the JOLTS numbers thus far, we'll have to see what it comes in this week. But all in all, it points to resilient consumer, resilient business, not robust, but resilience. And in effect, jobs showing resilience, that people have, there's mobility and labor remains relatively tight. We're going back to where we were just before the trouble began in 2019, which was not a bad period.
John, you're calling out the Rubenstein interview. It reminds me of a Matt Winkler column that I read a couple of months ago, in which he quotes Jamie Dimon saying that the economy, Jamie Dimon says, basically it's booming. And then we got this 2.8% GDP number last week. We were looking for 2% flat, and a lot of people were more bearish than that. Is the economy maybe too strong? Is the labor market maybe still a little too tight for the Fed to start meaningfully cutting rates this year?
We'd have to think that, and actually, we think the Fed is likely, we think with greater certainty, that the Fed will cut 25 bips at a time, once in November and once in December. It will avoid having its critics saying that it's politically motivated if it cuts in September. And also just gives the Fed a little bit more leeway, room or space to judge how confident it can be when it starts cutting. rates. So we think the end of this Fed funds hike cycle, boy, that's a tough one to say, is in sight. But it will require some patience, likely. And we could see, by the way, some of the rally that we've seen in smalls and mids be given back if that September cut doesn't happen. But that call for smalls and mids will likely be reiterated and rewarded so long as the Fed cuts in November and December.
John, we thank you so very much. Happy Monday to you. That is John Stolzfus of Oppenheimer Asset Management, of course, on the start of a very busy earnings week and busy week for central banks. Now, I want to bring you a check on Enstar Group, a merger Monday, or mergers and acquisitions Monday, rather, for Matthew Miller. Shares are down more than 6% here, interestingly enough, after it agreed to be acquired by a group that includes Sixth Street being the leader of the group, Steve Mnuchin's Liberty Strategic Capital, and J.C. Flowers. Stock is down, interestingly enough, below the offer price of $338 per share.
What does that mean?
There's a go shop provision, which I find interesting as well. 35-day go shop provision to this deal in particular. Let's see where this goes. That means that this is a live deal. But of course, this is a restart of that private equity industry. This is a $5 billion deal in all cash. We'll keep an eye on this market as it goes along.
Yeah, it's interesting, of course, to see shares drop, as you pointed out. And interesting, too, that you're seeing McDonald's actually rise a little bit. We're going to get more on McDonald's as sales drop, actually, for the first time since 2020. The analyst take coming up next. This is Bloomberg.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions, has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Open Interest. I'm Matt Miller. Here's a quick check at what's going on in stocks right now. Just 13 minutes into the session, we're still up about 0.25% on the S&P 500. The NASDAQ 100 up 0.7%, and the Russell 2000, the small caps, are just basically unchanged.
Yeah, faltering a little bit on the small caps. We'll keep an eye on that, but it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Tesla rising as Morgan Stanley names the company its new top pick within the U.S. auto sector, replacing Ford. Analyst Adam Jonas is maintaining his overweight rating and a street high of $310 on the stock. Next up, Barclays downgrading Bristol Myers to underweight. The analyst over there says that the company's persistent broader challenges remain even after the recent rally. And finally, we have Philips Securities upgrading Alphabet to a buy. The firm cites online advertising resiliency and an attractive valuation. Now, we also want to talk about McDonald's because shares actually up on what analysts see as a better than feared U.S. sales report. Quarterly sales, they did fall for the first time since 2020. So let's unpack this all with Michael Halen. He is senior restaurant analyst over at Bloomberg Intelligence. And it's really interesting here, Michael. Again, we did see that big, scary headline number, maybe better than feared on some of the sell side. But how are you unpacking this report?
Yeah, you know, to your point, results weren't great, but it was expected, right? Lamb Weston results and their guidance over the last few months has been pretty dismal. We know obviously McDonald's sells a lot of French fries. Industry level data, we use Black Box Intelligence, our great partner of ours, have shown weak results throughout the second quarter. Really didn't get a boost in restaurant spending that a lot of analysts and management teams really expected. And results have weakened into July. So, them saying that their results are still negative but in line with June, maybe even can be looked at as a small win here.
How much can the $5 value meal help them at the end of the day? Michael, I don't want to draw a stark comparison here, but you thought about what Red Lobster did to try to trade down in a massive way. Well, how far can you go is what I'm really asking here.
Well, they seemed optimistic, right? They said it's boosting traffic, but not sales yet. So I guess they're getting some sort of a mix shift. Some people that maybe will go to McDonald's and wouldn't order the $5 meal are being, enticed by that such a low price point with a pretty significant amount of food. So, they're positive because they say traffic usually comes before sales. But management admitted on the call that they're going to need to do a bigger revamp in the United States to really move the needle. That the 1, 2, 3 value meal isn't resonating with consumers. They've gotten a lot of shade online about the fact that you can't get an item for $1 or less on that menu. And so the real focus is going to be reworking that 1, 2, 3 value menu to have those low-income consumers that are struggling right now come back to the stores.
I could see myself going for a Bacon Cajun McCrispy and a Grandma McFlurry, Michael, because I make bad life decisions and I am weak. I have low willpower. But if I were able to get hold of some Ozempic or whatever the hottest flavor of that is, I'd be able to avoid that stuff. Do you see any of that coming through in the results?
Yeah, it's hard to parse that out. I think the impact from that is pretty minimal at this point. Over time, it could be more of an impact. What we're looking at is, maybe at some point when Ozempic can be acquired in pill form, we think there'll be some wider adoption, right? But, to your point, two places that people are looking at are definitely fast food and fatty food consumption, as well as alcohol consumption. But we're still kind of in a wait and see period right now.
Yeah, a lot to think about there when it comes to both Ozempic and also Matt's eating habits. But let's look to the rest of the week as well, because we also have Wendy's reporting, for example. You think about some of the challenges that McDonald's is facing. Do those also apply to Wendy's? Are these industry-wide problems at this point?
Yeah, they are industry-wide. So, in the past, at times when McDonald's has struggled, it's helped chains like Wendy's and Jack in the Box and Sonic. But we don't necessarily see that being the case this time. Like I said, industry level data is showing weakness across the board, especially with low-income consumers. That's 30-ish% of all of the traffic at quick service restaurants. So there is some concern about Wendy's. The stock has not been doing well ahead of this print, and it's a big concern is that they haven't really had too much to compete in terms of a $5 deal with McDonald's and Burger King to this point.
Michael, thanks very much. Michael Halen there of Bloomberg Intelligence talking to us about McDonald's results out this morning. Revenue fell quarterly for the first time since 2020. Coming up, Vice President Kamala Harris's war chest. In just 1 week, she's managed to raise $200 million. That's 2/3 of what the Trump campaign raised in an entire quarter. We'll look at that next in today's Wall Street Beat. This is Bloomberg.
Season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep Green World Cup. This is a 3
As the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
This is Bloomberg Open Interest. Let's take a look at the stock market right now. You can see we're higher, tepid though, to borrow a phrase from Matt Miller. The S&P 500 up about 0.2%. Big tech still going strong ahead of a pivotal week. The Nasdaq 100 up about 0.7% in Monday's trade. And it's interesting, the small caps, we were higher, matching the S&P 500, giving back some of those gains right now, though, Shanali, pretty much unchanged when it comes to the Russell 2000.
Switching gears now, Katie, time now for the Wall Street Beat, because after her first week as a 2024 presidential candidate, Vice President Kamala Harris has raised $200 million. Her campaign says 66% of her fundraising tally came from first-time donors. Joining us now is David Gura, host of Bloomberg's Big Take. And you think about where that money is coming from. What does it say about what the campaign is going to look like at the end of the day? The dollars are large.
Yeah, they've managed to capture a lot of enthusiasm and a lot of money as well. And what we've seen these last few weeks is her really traveling a ton, certainly by comparison to Joe Biden when he was the candidate. And her husband, Doug Emdorf, is in Martha's Vineyard today. He's going to host 2 fundraisers as well. So you're seeing, again, this effort to get people who are sitting on the sidelines to come in and donate money, but also this overture to high-dollar, wealthy donors as well.
The interesting thing to me is that it's not the same old people, you know, donating money to the Democratic Party over and over again. A ton of the money, I think even maybe the lion's share, is new donations.
New donations, and this kind of mirrors what we're seeing in the polls, which is, you know, a couple of weeks ago, it seemed like there were a lot of people who were undecided, who were unenthusiastic about participating in the election. They're now showing more enthusiasm, and that's really like who the campaign is homing in on, trying to get them to come and be donors as well.
So, of course, we've seen this big burst, but this comes after a lull of Democratic fundraising. And are they expected to keep this momentum going? Or, again, is this just sort of a enthusiastic, one-time sort of shot.
That's the hope, and so it's been just a couple of weeks, which is crazy to say, but we've seen Kamala Harris's efforts at fundraising. Now she has to pick her running mate, and part of that is to certainly not forestall the momentum that she's had, hopefully to carry it forward even more. So part of that calculus that she's going through right now in picking that running mate certainly has to do with fundraising. And so, the governor of Minnesota, Governor Walz, is somebody who's the head of the Democratic Governors Association. He's raised a ton of money for Democratic governors broadly. J.B. Pritzker, another person who's kind of in that dozen or so people who are being looked at, of course, has a vast personal fortune and lots of connections as well. So it's not like the decisive element in all of this, but certainly something that she and the campaign are looking at as they make this decision.
Who are the front runners here? Because you think about what you see in Arizona, for example, Senator Mark Kelly and his expertise in the border versus Josh Shapiro over in Pennsylvania has a swing state. What's more important at this juncture?
Well, and don't forget Pete Buttigieg. I mean, Matty Iglesias on our Bloomberg Opinion had a great piece about how well he speaks and debates.
Yeah, he was on Fox News Sunday this weekend, and I think everyone would say comported himself really well in that appearance.
There's
really
amazing shots from
criticism.
that
Amazing shots, and he's so good at that. He's certainly one of these 12 people who are being looked at. I will say the bulk of that list are governors, and so what we've kind of heard from the campaign is they're looking at people with executive experience. So you mentioned Governor Shapiro of Pennsylvania, won his race by a wide margin, has proven himself to be an effective fundraiser and somebody who's comfortable on the national stage as well. Roy Cooper of my home state, North Carolina, seen as kind of a similar way, a centrist governor with a lot of experience. Kind of connective tissue through all of these folks is they've been attorneys general before in their states. Kamala Harris is one as well. So she has some familiarity with a lot of these governors, especially who've come up through that path.
Just quickly, let's talk quickly about the Republican side of things, because Kamala Harris over the weekend calling J.D. Vance weird, for example, that's a direct quote from her, and it just feels like in general he's come under some scrutiny.
Yeah, and that's like very much a tack that the Kamala Harris campaign has been using, is trying to paint what Donald Trump's been saying as kind of off or strange or weird, as you say. I think that's going to continue. Look, Donald Trump was at this Bitcoin conference in Nashville over the weekend, delivered a big speech there that was kind of a mix of his stock and trade, usual boilerplate, getting into crypto as well. And he raised a lot of money on the sidelines of that, too. I mean, he had a fundraiser where I think the ticket went for more than $800,000 a head. So he recognizes, I think, the seriousness of like the way that the campaign has changed, the way that the donor game has changed as well. And so he'll be pushing ahead seriously in these next 100 days. It's crazy, just 99 days to go now until the election.
All right. Well, in some countries, that's a lot of time before an election, right? And maybe it's going to be a better thing for all of us.
I think that is. I mean, I won't say it's likely, but I think it'll bear some scrutiny.
Obama came out of nowhere, right?
That's right. I mean, there you go.
All right, David, thanks very much. David Gura, host of Bloomberg's The Big Take. You can check out that podcast on the Bloomberg, Bloomberg.com, wherever you get your podcasts, Apple, Spotify, whatever. Let's get to the trading diary, what you need to be watching this week. There's a lot. We get central bank decisions from the Fed, the BOJ, and the BOE. More big tech earnings rolling with Microsoft, Meta, Apple, and Amazon. Other notable earnings this week include Starbucks. And, as Katie said, we get big oil results from Exxon and Chevron. Coming up in the next hour, we've got Katrina Dudley, Franklin Templeton, Public Markets Senior Investment Strategist. This is Bloomberg.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors, including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.